I will sit down and start by contradicting a couple of things I want to get forward with you. So I apologize, Monica, in advance. I'm going to run through the presentation, but I really do want this to be as interactive as possible. You know, I'm going to, we have a lot of material to cover. There's a lot of speakers here, but I think that, you know, the place I want to start is with, of course, Safe Harbor. Yeah, we're good. The place I want to start is here. So a number of you here have come on the way back from Omaha. A number of others have been to the Berkshire Hathaway annual meeting a number of times. Myself, you know, I've been good enough to be hosted there by, you know, our great German hosts. And there are a lot of things that this business has in common with Berkshire Hathaway. Long-term focus, you know, a real hewing towards management excellence, real focus on value, making money, generating cash wherever possible. But, and the people that are here to a great extent because of those similarities. I want to talk about the differences, though. You know, there you saw this massive stadium filled with people. That was the tip of the long tail of Berkshire Hathaway shareholders. This is a different company. We are a different company, and I say we because I don't think people recognize how tight this cap table is, how much the owners of this business are sitting in the room, full stop. You know, if Alex from Black Sheep, who is on the stream, I believe, had been able to travel, the percentage of the active investor cap table in this room would be remarkable. You know, I thought about, you know, I had this slide as hidden, but I'm going to pop it up. This is the cap table. Yes, I will. Nope. Yep.
Here, back up.
Yeah, good. I mean, I don't need, frankly, that visual. I think we all don't have enough of an appreciation for how strange and wonderful this entity is as a public company. You know, what you want to see there, what I'd like everybody to take notice of is that when you remove the passive shareholders, the index holders, when you remove the algorithmic traders, and Monica did a lot of great work parsing this, this goes way deeper. What you have is a number of Canadians, a number of Germans, Irishmen, and then you're starting to get, you know, into the long tail already. I want to say two things before I jump into the remarks. The first is, you know, I flagged on the earnings call released yesterday that this is not going to be a welcome to two cows. I know there are a number of people here who are freshly interested. I know there are also a number of people who were longtime shareholders, got out and got back in. You know, this is a deep dive for the owners of the business. Then the last thing before I jump into the more formal body of this presentation. This has been a real down leg in the stock price. This is a tight cap table. I am so lucky. All of the Tucows employees that are back there are so lucky to be supported by a small group of interested, focused investors who take the time to learn the business. And during this tougher time, that support has been fantastic, has been necessary. But what every one of you has done is rightly, from a good place, worried about other people, worried about what other people think. All that matters is what we here in this room think. So I really want you to bring yourself to this day thinking about yourselves, not the street or the market or some amorphous spirit animal that we fear is out there but isn't. So bring yourselves into the substance of this story. And with that, I'm going to get into the first chunk here. For me, investors rightly have been trying to understand what's gone on with the stock in the last 6 quarters. And as I've taken all of your worries and concerns in, I think we can distill them down to 3 big questions. First question: will we default on the Tucows debt facility? One bit of nomenclature here, one bit of wording. I'm now going to talk about Tucows debt as what I used to call X-Ting. X-Ting sounds dumb. It works for me, but and so TCX holding company, Tucows, non-Ting business, Ting. Will we default on the Tucows debt facility? This is the simplest of the 3 questions. The answer is no. We already started paying down and delevering. That will continue. This facility exists. Monica, you want to take a look? This facility exists through September of 24. We are already actively working on it with plenty of interest and attention. Monica said wait until the end. I really, I'm going to encourage with each of these 3 questions, if anybody has any questions about them, now is the time. I'm going to go to question 2. So does anybody have any questions here? This is a very simple delevering story. The only other thing I'd add is that, for reasons that I've explained in great detail previously, we probably pulled $50 million or so out of this line to finance the fiber build that than we wanted to. Oh, you see mine. Good. And I think we've explained why we are here. We were not happy with that, but there you are. So any questions just before I move past this point? Good. Can we finance the fiber build? Second big question. And here I will start by saying that, when we started down the fiber road, 14, 15, 16, really through 17 and 18, I had people all the time telling me that we couldn't do this inside of a public company, that we were crazy to even try it. We saw others try that and choke on it. Nelnet was a huge company. They couldn't take the pain in their quarterly financials and ended up selling down to a 49% stake for exactly that purpose. I talked about this weird and wonderful cap table at the beginning. It really was my belief in that cap table, that belief in the people in this room, that gave me the confidence that we could do this publicly. I will say two things about where we are today. One, the hard work is behind us. Two, I think if I would have fully understood how hard it truly was going to be, I might have approached it a little differently. But the good news is I didn't know and persevered, and so here we are. So obviously, in terms of financing, the securitization that we announced last Thursday is a huge step in our ability to finance the rest of this fiber bill. In this section, if there's any of you who have questions about this, this is where I'd encourage you to ask them. I know that these securitizations are not necessarily traditional or can be a little arcane. Again, back to my comments at the front, I encourage each of you to understand for yourselves, so please do ask, particularly I don't understand questions. What this syndication allows now is us as operators to turn towards the full fiber build. So we are now able to lay out and think about this stretch in three distinct pieces. Scaling, which is everything from building all the internal business systems, building a huge construction company, building all of the ISP operating muscles that we had to develop and in many cases redevelop around the complete set of business systems. You know, I think that this business has gone from something like 60 to nearly 500 people in the last 5, 6, 7 years. It's scaling on the capital side. You know, we've talked about the securitization. I'm going to take you a little bit deeper in a second into the weighted average cost of capital for the breadth of this build. But there is this very clear scale portion of what we've done where we took $300 million or so in internally generated funds, built the business that we have today. And what we have today is now a business that is scaled operationally and that has the capital pieces in place. We now enter the execution phase. This will probably stretch into 28 or so. I think there will be continued build past that, 29, 30. There will certainly start to be some of the consolidation that will inevitably take place in the fiber segment through this period. But this period is about executing. Once that network is built out, once that network is loaded, you reach the maturity phase. These businesses in their maturity phase are incredibly profitable, generate tons of cash. You know, in that 27, 28, 29 time period, we're going to be looking at a fundamentally new set of challenges that will most singularly be about capital deployment. Think of those three phases. Think of the first, that scale phase, as essentially ending almost right here. Think of that execution phase as essentially almost starting right here. 4 years, in the early years, people asked, investors asked, the questions that investors ask. You know, how big will this business be? And I was very, very clear. We don't know. This business will be as big as we are constrained by our ability to finance and our ability to build. Those are the constraints. And for a long time, really until the last, I'd say 6 quarters, maybe 4, there wasn't really a constraint on capital as well. So I used to say, you know, it would be fantastic if we could get to $1 billion in capital deployed. It would be, crazy dream to get to 3 billion. We're now in a place where we can start to have what this period is going to look like come into sharper relief. In order for me to help you understand weighted average cost of capital, in order for me to help you understand the profitability of fiber, particularly the atomic unit, we have to estimate some sort of total build and scale. We believe today that that's most likely to fall in the $1.25 to $1.75 billion. There's a lot of things that could make that smaller. We'll see what happens with the debt ceiling this week. We'll see what happens with interest rates. We'll see what happens with the Ukrainian counteroffensive. Does China invade Taiwan? I could go on and on about the risks of that being a lower number. They're exogenous. I could equally tell you rosy stories of how that could be a bigger number. But again, this is kind of a nice center of the highway to start to think about. And that allows us to take a look at what a weighted average cost of capital across this might look like, across this cycle. So the pieces I want to call out here are, you see we announced, call it a near 240, but this is 850 here in the ABS. I'm going to talk a little bit about how we re-up in the ABS, but what that facility allows, it's an evergreen facility that allows us to go back to the existing lenders, as well as additional lenders who we met through this process, and to do further syndicated financings. One of the things that was very interesting to me going through this process, this is a world where generally capital is seen as tough to come by, and that is true. So many of the traditional sources of capital are being more hesitant. You certainly see that on the VC side. You certainly see that on the straight private equity side. There are a huge swath of lenders and funders who have money they have to put out. Assets like this, infrastructure assets that are incredibly consistent and predictable, are so fundable. So, my experience through this process, dealing primarily with insurance companies, was that there is a significant appetite for additional product. The other piece I want to talk about here, you'll see incremental equity. That is just a what if. I'm giving you a look at what a potential stack might look like. The reasons to raise equity would be to be a little more conservative, to put a deep-pocketed partner beside us for some of the consolidation phase. The reasons not to would obviously be cost of capital. So, we'll see. But the thing I want you to all take away from this slide is, first of all, this is just a sample. I can't stress that enough. I don't want anybody coming back to me in 5 years and saying, why didn't you spend exactly $1.45 billion?
The question in the chat, wait.
I'll give in just a couple seconds. That's great. I love it. But you'll see here this weighted average cost of capital of 8.12. That kind of low eights, 8 to 8.5, is the way we're thinking about our cost of capital in this cycle. Is that more than we would have guessed 2 years ago? Yes. Does it make this unprofitable? Absolutely not, and we'll get to that. I want to walk you through one more piece. I talked about re-upping.
on the ABS. I want to give you all a nice benchmark here. Every 8,000 subscribers we add to the network, we can get about another $50 million worth of funding. And I want to, through the lens of the ABS, I want to help you get there. As a borrower, I think this is such a fantastic facility. I'm going to explain to you why, in its simplest sense. This comes from me trying to explain a syndication like this, to people who are not financially sophisticated. You're doing a typical borrowing. You take your revenue in at the top of the business. You pay for all your expenses. You've got some free cash flow at the bottom. You service your debt. What happens in an ABS is that servicing gets moved up the stack. You take your revenue in. You are allotted a small amount that you can spend on maintenance. And think about that as the cost of maintaining the asset base as it is and not growing it. So a lot of work through this process goes into calculating that. That is done with a lot of objective professionals on one side and a lot of experienced lenders on the other. So what happens is now you have that small maintenance fee, then you service the debt, then you get the rest of the cash to go and grow the business. That small maintenance fee is less, certainly, than the rest of your operating expenses. As a borrower, why do I love that? Because I'm not borrowing thinking about defaulting on my borrowing. That's not, if I'm borrowing so much that I need to think about whether I will be able to even pay my debt, I probably shouldn't. So all I'm doing is moving the payment from this spot in the stack to this spot. To me, I don't care. But it creates so much more security for the lenders that it allows for lower rates and higher leverage. So now let me just simply give you a little walk down to that 8,000 subscribers. 8,000 subscribers, call that 80 million bucks. Sorry, call that 8 million bucks. 30% maintenance fee. I'm going to be coming back to that number. That's what we paid, or that's what's calculated in this financing. Get you down to 5.6 million of what's called securitized net cash flow. You take that 5.6 million, you multiply it by the leverage in the low eights, you get to your 50. Every 8,000 subscribers, another 50 million in capacity. This is a beautiful evergreen structure. And it rewards us for the things we do best. Run an efficient operation and grind down on all of our operating margins. How do you get the customers? That's penetration insured, where we are industry leading, and you'll hear lots more about that later. And then finally, quietly, maintain good relationships with these lenders. We have a quarter century of excellent relationships with all of our stakeholders across every business. So this structure is evergreen. It is beautifully leveraged. It's consistent with the things we do best. I'll take that question now.
questions.
3 questions. I always like to give priority to the room, as anybody here knows. Anybody in the room? Yeah, yes, Mark.
If you could switch back a couple of slides on the cost of capital.
Yeah.
So there is no footnote on the preferred shares, the 13%.
Yeah.
And I mean, if we think back, the cost of the preferred shares was in a range of up to 15%.
Up to 17.
Or up to 17.
13 to 17.
So with the announcement of you cooperating with Ubiquity in Mesa, California or something, does that mean that these costs have already come down?
No. This is just this is my by far most likely expectation, is what I would say. You know, look, us and them want to build as much as we can together. If you take $400 million and you translate it into, you know, sort of number of homes, it's just not that many, right? Over the period of the 4 years, there's lots of opportunity there. So you're just seeing an expectation. And Monica, you know, intended to footnote that and forgot. No, I'm totally kidding.
100%.
That was just Monica's comic foil. So that's the answer. I should note on the preps, there was a neat little bit of win-win business that I want to call it explicitly. Some of you may have noticed that Generate was the party that took the Cs. We did put this in the filing, but I think it was kind of sort of confusing. I had somebody kind of confused with it anyway. So what happened here was we used the Cs. Now, Generate, you know, really has always been doing a prep. They knew that we weren't selling equity in that process, Common in Ting, and but they of course wanted, you know, sort of as much of the benefit as debt protection as you could get. In this structured financing, the Cs are like a third mortgagee, where the last mortgagee is the one who gets to control the deal, right? If you think about the way a third mortgage works, if somebody defaults on their mortgage, the third can step in, keep the second and first whole, and keep the deal. It's now they're in control of the deal. So this was a way, you know, Generate, who was totally supportive of us getting this deal done, were able to step in and get a lot of the additional security they wanted. So they got a fantastic outcome for themselves in the capital stack. We got the benefit of essentially turning what's the least, you know, sort of the least desirable part of our capital stack. We got to knock out a chunk of it and essentially convert it from 13 to 11.5, the way I think about it. And we got a savings on some of that make whole, you know, of a number, I want to say it nearly 6 million, right? Under 6, but nearly 6, yeah, of nearly 6 million. So it was just a nice win-win. A little. We've also agreed not to draw now that we have this money for 12 months, and so we get we also don't have to pay a standby fee on that. So there was just a beautiful win-win there for both parties. We each got a great outcome, and it made a sweet deal a little sweeter, but that's kind of buried in the numbers. So sorry, that's more than you asked, but did you want to follow up on that, or you're good?
Thanks.
Yeah, Gabe?
Maybe just a question for me there. As you mentioned, incremental common equity, that's within the Ting entity, but you say that Generate was aware that throughout the process there would be no equity raised in Ting. Why did you decide to only consider securitization as an option, not think about should we bring in someone to market minority interest in Ting? Why was the decision no before even going down that path?
Yeah. So, you know, I use this language of waiting as late in the cycle as possible to sell common. Don't know that we are going to sell common. We may not. But, you know, this is a year, really, it's you know, when we were kind of trying to start to land the plane on that process was kind of November, December of 21. So, you know, at that point, you know, from November of 21 till now, and I know that was when the stock was at its peak. We have 50% more customers on the Ting platform than we did, and we have a third more addresses, and we have tens of millions of dollars of more invested capital in future CapEx than we did. We also have this securitization in place now. If we do choose to sell equity, we're in a much better place to do it today than we would have been then. The way these businesses are valued, good, bad, or indifferent, is generally pretty simply formulaic around customers and addresses.
Okay, thanks.
And now to the room.
Oh.
Oh, sure.
So I see there's no cost of capital attached to your own cash.
There you go, Andrew. Yeah.
What's the number?
Yeah, so the question is, there's no cost of capital associated with our own cash. That's because what I'm doing with this 8.12% here is comparing it to the return and then deciding if it was worth me deploying my own capital to generate that return. So in that sense, right, again, it's a question of how, what's the point of the demonstration, right? If it was, what's my cost of capital just in isolation, I would present it differently. But we're going to look at that 8% relative to the returns on fiber. Yeah.
How does that process work? Then do you have a line to draw on, or do you have to go back to them and say, look, bank pays another 50 million, and now we're trying to get it around whether it's 8% or 9 or something.
Yeah. So the question was, how do we do these subsequents? Are they baked in? Are they live each time? They are live each time. These are generally insurers. So what they're thinking about are their spreads. So, we believe that over time, so we are assured by third parties who know better than we do that as a first-time borrower in this asset class that we did fantastic. And I could tell you, some of the stories we were told in that regard. But you can go out and look at the other, transactions that painted the tape and see how we did, right? You're always going to be in a 4A2 process, the private process. You're always going to pay a slight premium to the 144A process just for liquidity. So even our liquidity premium, we think, was really small. So there is going to be, as we go forward, we expect as a subsequent lender, we're going to be performing against the maintenance cost. We think we're going to do better than we've laid out. So, and we think that the business will perform, and we think that that'll help us on a relative basis. So now I'm talking at a relative basis about the spread. When it comes to base rates, look, we are going to have to, like we did for years with the Canadian dollar, we now need an interest rate practice, right? We now need to have an opinion because, with these things, if you have no opinion, that's an opinion. So, and that's why you see me talk about, here's a range, $500 million range, 1.25 to 1.75. I've got a base case, right? I've got a base case where we build nothing else, right? You don't get to the same level of EBITDA. You don't employ as many people, right? But you're alive, right? Remember that with all of this stuff, across both sides of the business, there has never been an issue about investing to keep a business alive. It's all been about how much we invest for growth.
Okay. From Jerry Ward, are there provisions for refinancing the 8.2% syndicated debt when better financing rates are available?
No, these are fixed. So we take this money and it's fixed. There is no, unlike a lot of, for instance, commercial syndications, traditional banking syndications, which float and you've got to swap out to fix. These are fixed. Insurance companies are taking in premiums and they want to match returns to their payouts. And so when we're doing this, look, this is going to be similar to our Canadian dollar practice over the years. I'm not trying to be right. We're not trying to outguess the market. We're looking at any point in time and saying, at this financing, at this 8.2%, are we happy to take this money in and think we can invest it in a way that's really profitable for us? That's all. So we'll be making each of those decisions in the moment.
Okay, second one. It's not necessarily a question. It's more a
Statement.
a comment for your perspective. It's from Colin LeBeau. Mathieu,
Yep.
it's the internally generated capital should be seen closer to equity capital costs.
Yeah, and this is the point we were just discussing. So I've explained why. It's because you're comparing it to the return.
And Michael Wright, how does the 8.12% WACC compare to your estimated return on invested capital?
Well, look, we've said for 100 years, well, for 25 years now, figurative, that we like to be able to invest around 18% return, or sorry, around 20% return. We're going to go into great detail in the third question around the profitability of fiber. So that's it.
We have a new one, but from Parsa Kiai.
Oh, so just,
Yeah.
I can out him, right?
Okay.
Parsa is the biggest, loudest short. And welcome, because I think that's great.
Does the cost of the preferred include the make-whole provisions?
No, but I expect that money to stay out. If you look at the way it's priced in there, it's priced as not redeemed. Any more? So that's kind of yep.
What's the capital cost to build a network together? 8,000 subscribers, not penetration rate of the home.
Yeah, so perfect. That's right where we go next. So thank you for that setup. So just before I leave it, any other questions on how we finance the fiber? Oh, yep.
What was the asset-backed notes issued at? The OID said 8.2% effective rate, but it's unclear if that is on a 2028 maturity or 2053 maturity.
Yeah, no, that's on the 2028 maturity. The way these notes work is they have a 30, for reasons I'm sure knowable to me, but unbeknownst to me as we speak, they have a 30-year term, but it's effectively 5 years. So they have punitive ratchets after 5 years. If we wanted or needed to, we could leave those notes out for 30 years as long as we could service them. They start to become amortizable, and the rate jacks way up. So there's a huge incentive to refi them. And what happens at the end of that 5 years is essentially you have that securitized net cash flow back to be able to sort of re-put out. So now, this is fiber profitable? The last big question. We'll spend probably the most time, certainly I imagine the most time here relative to those other two. And, I'll give you the TLDR, I'll give you the short answer. Fiber is indeed profitable. Now let's do a deep dive. In order to determine the profitability of the atomic unit, you got to look at 4 pieces: build costs, penetration, churn, and operating margin. As we move into the company sections, you're going to hear separate presentations on build costs, penetration, and churn. I'm going to talk here, before we get to the company side, about operating margin. So just, if you want to kind of dig deep on the other 3, you will get a subsequent chance. We can talk a little bit about them now. Operating margin in this business is extremely difficult to communicate. So I want to start by talking about how we run the business, how we look at things internally. I talked about that concept of maintenance cost, 30% in the in that SNCF, in the ABS or in the syndicated financings. So what that doesn't talk about is the amount for growth. You know, where is the expense around growing the business? But that's kind of hard to completely separate from those maintenance costs. You know, is $1 of marketing on a billboard about a new customer about maintaining awareness? You know, I could give you a dozen examples at an operating level. But I want to describe two separate frames. One is the one we've tried to present in our public disclosure, city level and national level. And the other is this concept that you see through the syndication of maintenance cost and new customers. Those things are similar, but not identical. We could not, it would be impossible, it would be extremely unproductive if I had to ask our finance folks and I had to ask the operating folks to track their efforts in a way that allowed us to precisely, for public company disclosure, say, this is maintenance and this is new customers. I want to tell you the way we run the business. With the construction overhead costs, we look at how much operating expense we spend per dollar of CapEx. We have a view of what that number looks like across the industry, and we have a view of how we want that number to look like over time. So just think conceptually there about a construction company that has a CapEx throughput. When it comes to marketing and the marketing costs, we think about the cost per order, and then we think about the cost, and that's mostly, that cost per order is mostly working ad spend. And then you have all of the people who are able to put out and maintain a level of awareness and, you know, spend that money efficiently. Same with support. Internally, again, we try and track the cost of onboarding. We look at the different business processes, we bucket them. How much does it cost us to onboard a customer? How much to maintain the base? I say this just so you see the way that we internally track these expenses. This allows us to measure their efficiency over time. Every one of these things is a flow. This is not amenable to a stock or to a public disclosure. I do want to note, as we turn our minds towards now, you know, if I bring you back up to scale, execute, as we turn our minds to execution, the fact that we are moving to our next generation of software stack with Wavelo is going to help every one of these expense structures. So in order for me to kind of give you a sense of, is our current level of spend reasonable or not, I've got to take, and you can see I'm stressing here, this is one of many possible outcomes. I've got to give you what a rough build plan looks like. So this is, if I'm not mistaken, the build plan that's kind of in that 1.45 billion that you saw with the WACC calculation. You see here, million past 900,000 serviceable, half are organic, half are partner. You see here end of period subscribers, that's across both types. And you see here annual revenue. Where we are currently around national costs is in that run rate, kind of $40 million range or so. You can see where I think about that is, because we're pretty close to scale now. When our operators are looking at their businesses, are looking at their business units. They don't have a lot more to do to build their throughput. Remember, their throughputs are determined by how many customers are we adding? How many customers are we onboarding? How much CapEx are we putting out? And we're close to the levels that we need to be through this segment. So I think about that kind of relative to this annual revenue, and I think about our current level of national costs as being in that, or as being in that 10 to 12% range. So when I think about our current level of profitability, I think about it as in the high 50s or 60%. Would I be happy with that entering the maintenance phase? Absolutely not. Am I happy with that as we have just finished building the factory, as we have just finished building the machine before we've turned to optimizing it? Yes, I am. So now I want to take you through a couple, what would I call this? A little bit of the history of assumption. And we're going to try and sum all this stuff up. You know, this is a slide that goes back to 2017 or 18. From 2014, from the time we got into fiber, until about 17 or 18, I used that kind of $3,000 a customer number instead of $1,500 an address number. That became too far afield from what everybody else reported, and so I changed it to an address number at the time. It's amazing how consistent these things have been over time. There was, you know, you would have heard me say a number of times on earnings calls, particularly the last, you know, kind of 3, 4, 5. Well, I haven't restated that 1,500. I've said we have seen costs, you know, move up a little bit. There was a New Street conference a couple months ago now. Great private equity panel there. They laid out that costs to build had increased in North America between 10 and 20%. When we looked at our target build, and remember that now we're using current costs, running the build that we've got till date out to a terminal period, you know, we saw 1650. It was actually 1645. You know, for me, that was great. There we are at kind of the low end of what the increases would be. So this is the way that we think about those 4 key assumptions that I talked about earlier as they relate to profitability. I'm going to show you, you know, there was enough internal debate about which way to show you these treatments. So I'll show you both. You know, there's kind of a look now. I should note when I'm looking at these numbers, the numbers that are most consistent for us, the ones that we think are most predictable, are the cost to build and the churn. And the ones that we think have more variation, primarily because of, you know, exogenous factors out in the world, are the operating margins and the penetration rates. We can run this we have run this holding every one of the 2 constant, every one of the 2 variable. This is the one that I think is most representative. So if you want to think about, in my mind, the way I'm thinking about the base case, it's kind of like, here's where we are today. Here's where I think our expected, my best guess outcome is. And I think we've got upside everywhere. Show you a slightly different treatment, which just holds and shows this same thing as bar graphs. But I want to stop here and take questions and probably leave this up while there's questions. You got anything there?
Not yet.
No? So I know that was kind of chunky and you you'll want to digest, but, yes, Andrew.
You just cover a sort of adoption percentage of that, another percentage of past homes or service providers.
It's going to be service.
And the high 50s and 60s.
You can't penetrate a pass, sadly.
And then the high 50s, low 60s today, 67 location. That's a what? That's an EBITDA margin.
I would call that a,
Can you repeat the question for everybody online? Because they may not hear.
yeah, I didn't repeat it there. I'm sorry. Okay. The first was penetration, a function of past or serviceable, and it's of course serviceable. So that's what I would call a net EBITDA margin. It's, I look at it as a cash conversion number. That's always the way I'm thinking about it. And again, remember that I'm thinking about that as kind of close to scale and then in a scaled business, right? So I'm thinking about that as a margin that you start to get in that 27-8 timeframe, right? Because until then, your operating variables are a function of these flows. How much CapEx do you put out? How much, how many customers do you add? How many customers do you own?
So it's EBITDA pre-tax, but it's not just the profit of the local markets that we cost embedded and then after deducting.
You should get a microphone because I don't want to repeat every bit of this.
So the 60 to 70% target profit margin, that's not just an EBITDA margin at the local market level when you're at maturity. That includes covering the cost of the
That's right.
national cost, and it's net of that, and you get to the.
That's right. Because, we think the national costs are just not going to go up that much. I say not going to go up that much because, I want to squeeze them to have them go down, right? So I'm being nice by saying I don't want them to go up that much. But there you're just doing that over this whole base of business, right? And again, the syndication process was fantastically helpful for synthesizing the way to think about what maintenance looks like on these businesses. Yeah.
So first of all, thank you for doing this today, and I think it's been very informative. Two questions, and one to kind of Andrew's question. Does that mean on a kind of mature market contribution at scale, once it's built out, we talk at a, what's that, 90% then, or 85% margin? And you activate all of them and then slap national costs and end up being at 70%?
Yes and no, because remember that what your national costs are doing at that point, right, are, it's like, if you want to look at, so you have to say, are we talking about two frames, right? City and national, which is what I'm identifying. It's kind of the way we got to do public disclosure, right? But think about it now through the lens of maintenance and one-time or growth, right? So if you're growing, if it's anything more than that 30%, right, then it's adding to the asset, right? So if you really want to think about the profitability of this, right? You and I own one of these footprints. We bought it from Tucows, right? You're now at 50%. You're doing one of two things. You are maintaining that 50% forever and clipping coupons, and we're both enjoying our island somewhere depending on the size of the footprint, or you're growing it, right? Oh, I want 55%, right? So in order to think about profitability, you've got to sort of stop the bus and say, okay, what's my profitability here where I'm maintaining? So now when you say that 30%, look, I want that maintenance cost lower than 30%. We've started at 30%, right? Just think about a simple thing like in the maintenance cost, of course, is all the overhead of a network. When the network gets more efficient, first, you go into a footprint, you got to rack and stack. Now all you got to do is add another pipe, or you maybe even add another wave to an existing pipe, right?
Okay. Thank you. Second question, sorry. On the
Stay to the microphone.
On the IRR, does that assume some sort of terminal value math?
No, so we went back and forth. It's
100-year DCF that you
Yeah,
just.
I think they did 50. And the reason is because of the way you can model, and I mean, George, you're welcome to jump in, or Andrew on this one, but if you actually, if you do a terminal value and the churn, right, like then it actually makes it better. Like it's a perverse outcome. You end up making the return better by having the terminal value.
I agree.
So we just wanted it to be as clean as possible. You know, we want to, this is a, you know, as you can see me doing with pushing back on that growth piece, it's like, okay, look, we're talking about the atomic unit, right? So we've got to, you know, you got to at some point stop and say this, you know, it's no longer in motion. It's stable.
Which assumes that if you and I
Yeah.
find someone with a lower cost of capital than 18% because we need to buy our island, the IRR from today's vantage point would be significantly higher, right?
No, it's unlevered, right? I'm comparing the return. So I got to still pay for my money here. Right? Yep. Well, you know, again, to your first question, depends on how you want to price equity, but yes.
What kind of competitive environment are you operating in right now, and what's your assumption in the future? Because, you know, we read about fixed wireless access, some of that being as well. And
Yeah, no,
activity.
yeah.
And
So I want to just, and I apologize. I want to put, you know, we've got a great investor video. It's about 2 or 3 years old on fixed wireless. And so I want to push you to watch that as it relates to fixed wireless. But, you know, look, I'm going to talk a little bit about the relationship between fiber and coax and the way that's playing out around the world. But, you know, at the end of the day, these are going to be fiber, coax, other markets. You know, my default is 50, 40, 10. I think I'm being conservative. I'll walk you through why. But, you know, it's kind of what we're getting now. And I think that the coax providers have a lot more constraints than we do as things get tougher. And, you know, we'll dig into that potentially. So it's a good one for the end. You've had, Jeff, go ahead. Did you want? Nope. Jan? Yeah, go ahead, Jan.
Sorry, sorry for the second one. So you put out disclosure last night on kind of what you expect total CapEx, but not only CapEx number for the 1.25 to 1.75 billion. Now, if you divide that with kind of the number of potential passes, you get to numbers significantly higher than the 1,600 you put on the other slide. Now, obviously, that you would need to add some installation to that, but
yeah, you got to do. So you want to think about installation will take you up by. You know what we'll do is for the QA, we'll do a little workup to get you back to that. But the one thing that people do forget, except in the period, is the operating losses. So remember that money also has to fund the, you know, I've told you about a $40 million loss this year, right? This will be, I think, the peak, but you know, like that's still, if you take this over, so that's another chunk of money.
Just silly question.
Yeah.
I assume that's all in your IRR, right?
Yes, of course. Yeah. You had one there.
I do. This is actually comes from Andrew Walker. This is.
You think I'm going to like it?
It's yeah. Sorry.
I try and be neutral as to
Andrew
whether I like the
Walker.
questions or not.
Ting fiber versus ILEC fiber.
Yes.
You know, we did. I think the competitive environment question spoke to this a little bit, but basically, ILEC guides are 40 to 45% after 3 to 4 years. So why is Ting different?
Yeah, I mean, we're just so. I'll probably come to this a couple times through the process. You know, we've been on a long journey over a couple of years, spoke to so many potential partners, looked at so many different opportunities, particularly through this syndication. You know, this process of syndication has become quite
popular in the mid-market builder space that we're in. The mid-market builders, people like us and Metronet and Allo and Greenlight and others, we do better, all of us do better than telcos, and that's for a simple reason. People hate telcos. So, you know, that one's not complex. And then inside of that mid-market builder, our penetration rates, our churn, our feels like, based on what we hear from external sources, best in class. And so, you know, we'll just attribute it to the great customer experience that we provide once customers are in the boat.
And one more online from Gianluca Tucci. Are there any available government subsidies or equity/tax credits at the local or state, federal level that exist for fiber builds?
Yeah, look, there's loads. You know, there's $40+ billion available in the U.S. We are in the short term really not thinking much about the grant monies, and that's primarily because they take your construction resource, which is a scarce resource, and reallocate it to less lucrative footprints. So you might get cheaper build costs, you might get equal returns, but you have a less valuable asset. So we really, particularly in the short term, are not focused on subsidies. I will note that there are certainly opportunities that we get presented to us where there are federal subsidy monies involved. Those tend to be very specific opportunities, and that's a state or a city, you know, reaching out to us to talk. And you know, it's all about capacity, and you know, we look at every deal.
Colin has another question. Are there any services that could be added to the fiber at home internet connection to add revenue to a customer?
I mean, the short answer is yes. You know, spoiler, that's one of the things I'll call out later in the presentation. You know, we're doing this bold. We're doing this assuming nothing else. You know, I could go deep around 4 places where I think that's an extremely conservative assumption, and that's where I think we should start.
There's a couple questions in
Yep.
to this.
Just a question about competition. Recently, Verizon had stated that they are starting to move into more rural areas. Do you see that as a potential roadblock for new commitments?
No, I mean, we're not really looking at rural. More importantly, there's still so much out there. You know, and we've got one of the benefits of being 1 million homes in a 140 million home market. You know, you need 1 or 2 sort of, you know, good pockets, and you've made your book, right? So we have the, you know, benefits of being small as it comes to these footprints. There's lots of action, and I'll kind of show soon, you know, how that sets up and why it looks good.
Are these after-tax numbers?
Sorry, say it again.
Are these after-tax numbers or like the pre-tax?
After tax.
After tax. Your hand was in front of your mouth, and it was making. You know, one of the things I learned during COVID was how often I'm actually reading people's lips as opposed to hearing them. No, these are before tax. These are before tax. The good news in this business is we are piling up massive tax losses as we go along, you know, if you want to sort of an upside. So through this cycle, we don't burn through them. But absolutely, these are pre-tax.
Here and then here.
Could you provide some insight on what the fiber atomic units look like for wholesale?
Yeah.
And what's the experience in Westminster taught you about the incremental profitability opportunity?
Yeah,
for wholesale?
that's good. So we do I think do a little partner treatment down below. You know, the spoiler would be, you know, you kind of have your $600-800 of install, right? So you've got, call that a, you know, a third roughly of the CapEx. And then you give up about 40% or so, very high level of the revenue. And then you just roll the other variables through.
So how do you think about whole
Yeah.
store at a holistic level?
And you know, and you'd asked about Westminster specifically, you know, it's a very bound footprint, you know. When we started, you know, we agreed to do Westminster in 2015. It was a very specific circumstance. We didn't know if that was going to be the first of hundreds of partnerships like that. And both us and the city representatives, and by the way, some federal government folks, you know, everybody wanted that to be a model that people picked up on. So it was an experiment. You know, the good news in this business is, you know, whether we're talking about Sandpoint, which I called our experiment the small for years, or Westminster, it's like, you know, you can make, you're making money on your experiments. And my grandmother always told me you never go broke making a buck. So, you know, it's you know, we're in Westminster, we're kind of bound when I say that. It's like, you know, they're not building, political fortunes turned over a bit. So there's not a lot of place to take that, but it's great. I mean, you know, like the thing itself is profitable, so that's fine. Did you have a follow-up? Sorry.
Just wondering outside of Westminster, just how you think about it.
Yeah. So in general, look, you know what, I'm going to talk more about partners. So save it and then come back when you hear my comments there.
Margin rate like 7.28, set a close to cash net EBITDA margin.
Yeah.
If you were to move all the way down to the cash flow statement, with true free cash flow margins, then in the future, like, how was that comparing what would be the items?
Yeah, I don't want to jump to it. I want to think about it. Note that, and maybe we'll come back to that on the QA. You know, I want to think about where the install cost fits in, because you do have, you know, the way you think about maintenance is you take your 50, you know, that's going to be X number of homes. You don't churn out whatever your churn, you know, whatever you're assuming for your churn, and then you replace those exactly. So you've got the CAC and the install, but I think that's all going to be OpEx. So I think it's all kind of in there, but let me think about it. Like, I don't know that there's much in the way of below the line free cash flow. I mean, you know, do you want to tax burden it? Do you want to interest burden it? You know, it's going to come down to those questions. Yeah.
Look at this slide here, margin rate and adoption. Those are fairly low, right? I mean, you have the higher adoption, the higher should go on. Partially, or where are they going wrong?
They are positively correlated, for sure.
Can you repeat the question for her?
Oh, yeah. So this is, I'm going to rephrase that as, you know, well, no, I won't rephrase it. It was pretty close to, you know, well, the higher your adoption, the higher your margin. So that's right. Those are positively correlated. You know, I'd have to think through how to, you know, I don't know that that would impact the presentation, right? So I have to think about that on an operating level as to what that would do. I mean, you'd have to make a bit of a, I don't know, like you know. Yeah.
75% margin at 14% adoption, probably not likely, so it's very good there.
Well, what you have to spend less on replacement. You have lower economies of scale, but would that matter? So I don't know. I think it's interesting. It's interesting to think about. There is for sure a positive correlation. I cannot tell you whether it matters materially or not.
One more online question from Bentley Cross. What drives your special sauce to get margins that high? If we look at peers, their lower frontier arguably has more scale and is at 45%. Long-term is talked about 55.
So that's great. We've talked lots about that through the syndication process and, in a lot of the discussions that we've had externally. Look, we are an ISP doing telecom. We are an internet company doing telecom. Everybody else is a telephone company doing ISP, a cable company doing ISP. You for sure do have in some of the other mid-market builders, some of them, Metronet, Allo, dial-up ISP routes like ours. But that is, that is by far the exception. So why does that matter? We have a cleaner back office. We have a cleaner back office than the telecoms, than the cable companies, and than our mid-market peers. Think about what we did in the domain name business. A lot of you, one of the great things about this cap table is it's long-lived. So many of you I've been in dialogue with for so many years. When we went from the domains business to the mobile business, what I told a lot of you who were saying, what are you doing? Why are you doing this? What makes you think you can do this? I would talk about taking something we were great at in an incredibly low margin opportunity and taking those same skills and applying them to a higher margin opportunity. In the domains business, what is that business? It's a big billing and provisioning platform that does 25 million transactions a year. This is, why is our thing better? Because we have clean billing and provisioning. I will tell a quick story. We looked at a lot of things. One of the things we looked at through the 2+ years that we were, kind of going through this journey is a large existing telecom. When we looked at what the software stack looked like, it was 64 people, $45 million a year to operate, and a steaming pile of crap. When we were trying to pencil out what we would spend, I had to lie to people because they just wouldn't have believed that we would be that much skinnier. And when I say lie, I mean, I had to overestimate. I had to pad the numbers. I have now been under the hood of these businesses. Before I was ever under the hood, I thought they were likely a mess. They were way more messy than even I expected. So, I think our secret sauce is that we run this like an internet company. I don't think what we do is any different than any of the thousands of internet companies who are disintermediating or have already disintermediated for 10, 15 years across so many other problem spaces. A number, and I'm sorry, Justin, for getting out ahead of your number, telecom is 5% migrated to the cloud. What the heck? So really at its simplest, I think by far the biggest thing is clean tech stack, clean back office, the sensibilities of an ISP using modern internet practices. In addition, look, here's what's true. When you are customer focused, when you design your business processes around the customer, they are simpler, cleaner, more effective. They are always in the short term less profitable, and they are always in the long term more profitable. It would be more profitable in the short term for us to charge a bunch of bogus fees on our bills. We choose not to. There's the simplest example. And I can give you dozens and dozens. So, anyway.
I have no more questions.
I thank the questioner. That was great. Please remember who that was, because it just lets me get on to my favorite topic.
I would say if you want to finish through your slides.
Yes, I
and then
know.
we might break for lunch. So
Oh, really?
We're at lunch already. Okay, is fiber profitable? And we have not started Ting. Great. I've got one last question before lunch.
I just got a question on the securitization. The 30% that you mentioned that you have to maintain the asset base. How is that affected in the IRR?
They're separate concepts. So when you say how is that accounted in the IRR, that informs the way that we think about what net margins will look like at scale. But it's not accounted for in any sort of precise sense.
If you take that, deal, so as you said, 8 million in revenues. If you get $2 million in financing, and the 30% maintenance, you get 5.2 in revenues.
5.6.
So that 80% is that 5.2 is it
5.6.
So is that in a sense?
Is that?
Is that operating earnings, or do you not?
No, it's not operating earnings. It's what's called securitized net cash flow, which is a syndication concept for the amount of revenue that they'll sort of apply the leverage against.
Because I was just doing some rough numbers. So what I get from that is if you get 5.2.
You keep saying 5.2, 5.6.
Okay, so 5.6, and you earn that at a 60% margin. But your financing is at 8.2%, $50 million. You don't really have any net cash enough once you do that.
Nope. You're welcome to. You're welcome over the lunch break to sit with George and question his math, but there are the numbers as calculated. You've just made a statement. You'd have to show your work. So we're happy to sort that out, and George and you can sit together at lunch, and we'll let people know the outcome when we're back.
Yeah, and just to be clear, lunch is set up in the back area of the room. It is a working lunch, so if you could get your food and return to your seat, and we're going to start up in about 15 minutes.
So we're going to now go down into the three businesses and a little bit on the holding company, and then all wrap up. Again, the intention of what we've done to date is to try and help you all worry less so that you can be more present for the deep dive into the businesses. Now, we are going to go down into in the fiber business, the three other variables as I described, but I want to start with a little bit of an overview, a little bit of the fiber meta. And I'm going to start with a quick story from the UK because the fiber market globally really contains some mysteries for me and ones I'm trying to understand. And what got me down this road was a headline from a company that was, I'm deep in the securitization process at this point. And I've already been to structured finance in Vegas, and I've met with all the insurance companies. I know what we're sort of looking at. I know what they're digging into, and I see this financing. And so, I reach out to some bankers who might have some familiarity with it to try and understand it. And it doesn't make sense to me because, the bulk of where we're building, we're the only fiber provider. There is a little bit more overbuilding specter than there's been in the past, but we still expect the vast majority of our fiber network will be the only provider. In the UK, it's a very different story. In the UK, you have Vodafone in 2/3 of the country with an open access network. You've got BT in 2/3 of the country with an open access network. At its simplest, think about those two networks overlapping in 1/3 of the country. So now you also have what they call altnets. Altnets are companies like the one I showed you, Netomnia, who are also building fiber. So if you are one of these alt nets in the UK, what you're doing is you're building in the least dense places with one other fiber provider, and in the most dense places with two other fiber providers. So I've just gone through this experience where I've understood the way that lenders are underwriting these deals, how they're thinking about it, what their variables are. This made no sense to me. So we talk about this, you know, I dig in, and I literally have a conversation with a guy, you know, where I'm saying, what's the terminal take rate of fiber? What do you mean? Well, what's the market share going to be for fiber at the end? What do you mean? Well, there's coax in the UK, right? Yes, there's coax on my street. Okay. Well, what's the terminal take rate for coax going to be? Well, the terminal take rate for fiber is going to be 100. And so what lenders are underwriting in the UK is essentially coax going out of business. I shared with Marlena, who's on the board, and Jan, who is newly in the fiber business, which I love because now he's going to have, you know, all of the disclosure challenges that I did. So, and I'm happy to have blazed the trail. So, you know, I shared an article with them this week where that was the debate. You know, what's the terminal take rate of coax going to be in Germany? Is it going to be 0? Well, I can tell you that in North America, the terminal take rate of fiber, you know, we talk about 50%, we're seen as high. We are seen as high. So for whatever reason, and certainly the markets can be different, but I don't think they're that different. The terminal take rate of coax in the US as being underwritten by, you know, the biggest lenders and the biggest private equity providers is high. It's 40, it's 50, it's north of 50%. I think that's very important. You know, somebody's going to be right here. I like the fact I share all this story just to share with you, you know, that we think our penetration is kind of sort of conservative. That's big point number one that I want to lay out in the meta. The second is that there really is a lot of partner activity. We have our partnership with Ubiquity. A lot of you will have seen the AT&T and BlackRock joint venture where they're building outside of AT&T's existing footprint. In the top right, you see Meridiam, which is a French utility. They've built in Bloomington. They're going to be building in other cities. They've committed billions to the US market. You see Intrepid, which is a joint venture between Brookfield and, you know, Brookfield stood up a wholesale provider. They announced T-Mobile as their first tenant on a network a couple of weeks ago now. There are others. Tillman's got something that's supposedly out there as well, the big tower company, and more. There are not that many tenants for these markets. So I lay this out there as a question that we have. You know, you just see here probably $10 billion in capital that's going to go into this cycle. I don't know where the tenants are. I don't think that's going to mean better rates for us, but I do think it might mean some better terms. We really do think about these businesses, these pieces of the business severally. I've always talked about every fiber network having 3 pieces: capital, construction, and ISP operations. The first 2 are around for 18 to 24 months, and the last is around for 100 years. We have been able to stand things up in a way where what we do in the partner side and what we do on the organic side is independent. I identify it because it's the type of thing where the next year and the next 2 years, this really could have, you know, important bits of revectoring. And the third thing that's mimetic, that's out there, You know, 18 months ago, when the stock price was at $90, fiber was not accepted as the unquestioned winner in telecom. It was seen as a strong story. It was seen as more interesting than it had been a couple of years ago. But now fiber is so accepted as the winner in telecom that in North America, they are now questioning whether a mobile provider can survive without fiber. That's remarkable. That is such a sea change. And by the way, when you see T-Mobile acting as a tenant on the Intrepid network, what you see is their confirmation of this fear. T-Mobile does not necessarily play nice with the other children generally. They don't, this is them partnering. So, you know, I think that I highlight those three big questions that are out there in the meta. And then, you know, I just kind of want to, you know, we've now gone through a big syndication process. We've talked with lots and lots of external parties. You know, this is a bit that's kind of clipped from the syndication sim. But, you know, what I've come to now feel externally validated about is that we have generally higher penetration rates. We have generally higher, lower churn rates. We have generally more efficient operations. One of the really interesting ways that manifests was how quickly we were able to execute against the syndication. You know, we had multiple junctures where the bankers who were supporting us expected us to take some few months getting back to them with a technical requirement, you know, financial technical requirement, and we'd have it in days or weeks. I'm thrilled that, or it was that I experienced that external validation around those penetration rates, higher, churn, lower, operations more efficient. That operations more efficient, of course, is going to track down to net margins at scale. And then, you know, the last bit there is around build costs, and that's what we're going to talk about in a second. The last point, I think the last point, yep, that I'm going to make before I turn it over to Jason. You know, again, surprising for us, the fact that we have a more distributed footprint than a lot of the mid-market builders our size was really seen as a positive. It was seen as diversification. You know, the bulk, when you see me present a possible outcome, a plan that I did, which is a fully baked plan, and I want you to know, we know what we're doing for the next 12 months. We're pretty certain what we're doing for the next 24, and we've got a good view beyond that. But, you know, obviously we cast that every quarter. This footprint, this distributed footprint, the vast majority of what you saw in the plan that we presented is in these footprints. So it's not about opening up some new territory, and I think that's very important. So, you know, I've talked about those other three variables now: the penetration rate, the churn rate, the margin performance. Our cost to build and our cost of installation are a little bit more expensive than others. Jason runs the construction company. I hope you don't mind that description. I always liked it. It feels so pithy. Jason's, you know, very experienced construction operator, Google level 3, etc. You know, and so I'm always turning to him when I'm dealing with these external questions and saying, you know, are we expensive? You know, should I be worried about this? Is this not shaping up? You know, come on, man. You know, you've been doing this your whole life. Like, what's this like? And so what you're going to see here is really you know, kind of presenting to you a synthesis of his answers to me, and hopefully you're as satisfied with them as I am. There you go, man.
All right, thank you very much. It's interesting, my career started with an ILEC in the Southeast back in the 90s, and then I worked for a cable company, and then I worked for a fiber to the home overbuilder, and now I'm here. So I've had the luxury of kind of seeing all the different types of operators out there over the last 28 years. And it's definitely shaped my perspective on what's good and what's great. We're going to drill into the 1650. You're all curious about it. And we're also going to drill into our activation costs because I know people have questions about that. And after I show those to you, if you'll bear with me, I'll talk you through why those numbers are great numbers. So construction cost assumptions, let's start there. If you had a chance to watch the video that we put together on this, we talked about engineering and design, we talked about primary infrastructure, then we talked about access network. I wanted to point and kind of highlight the access network piece because I'm going to show you what industry typicals are, and I'm going to show you what our typicals are. And you're going to notice that the biggest differentiation is with the access network. So that's where we'll spend most of our time today. So typical construction cost. Now, these are averages of averages, and I'm speaking in ranges. So if you ask me in a month to speak to a very specific number based off of a period of time, it will look a little bit different. But when we generalize, these are the numbers. You'll see that engineering and design, materials and equipment, typically commodity price for for everyone in the industry. Primary infrastructure, you'll see a little bit of differentiation there in total cost. We're a bit higher based off of what I've seen and done in my history. Primarily because we are building a 100% new infrastructure. We're not leveraging existing POPs. We're not leveraging existing anything. We're building everything from new. So that does drive our primary infrastructure costs up a little bit. But also a key differentiator is that as we're deploying at this point in time, everything we're putting in is multi-gig equipped. Now, historical numbers by the industry are definitely influenced downward by the older technologies that are capped at 1 gig. So we have a little bit of an advantage there as we move into higher speeds as time passes. That last bullet point there, the last section, access network, that average industry cost is pulled down over the years, but primarily by aerial construction and in some cases, low quality underground construction. And so there it is. Ting, what are we doing? We're building the newest, and it really is the best. We're not the only overbuilder building this way, but we are in a group of overbuilders that are investing in the lowest operating cost model for this business. So let me go ahead and flash through our activation costs. This one has a little bit of differentiation everywhere. Equipment and materials. Average industry cost is a bit north of 250, somewhere between 250 and 300. We're a little bit lower just because our customer base seems to have a proclivity for providing their own routers. We'll take advantage of that. It's wonderful. In-home installation labor, historically 125 is a great number if you're going to leverage contractor installation crews, which is the typical methodology. I was pleased when I arrived at Ting a year and a half ago to find that the company had invested in insourcing and staffing up in-house technicians to perform our installations. This is a wonderful thing if you're willing to go through the operation and the investment in supervising and managing technicians, and it does result in lower cost. If you think about the cost of a technician is a set rate, if I'm paying another company to manage that technician, then the company that I'm paying must make margin. If I can direct hire those and then create an efficient management structure for them, then I can save some money, and we are on in-home labor. Service drop, now this is very important because this is a tremendous differentiator. Average industry cost is south of 400. We are in the mid 400s. Very specific reason for that. Number one, goes into the aerial network. Aerial drops are usually cheaper. And most companies are just going to bury the fiber from the side of the curb to the side of the house. They're just going to put it in the ground. Brush some mulch over it and call it good. All right. I was pleased once again when I made it to Ting to find that the standards that we put in place originally involved putting a pipe, a conduit, from the side of the curb all the way to the side of the home. That pipe protects that service drop. I'm going to show you the impact of that in a minute, if let me get through these. So fourth bullet point, capitalization of management and HQ labor. This is something that the industry doesn't typically do very well. I'll let the industry answer for itself on that, but we do a pretty good job, a very good job of tracking how our overhead is committed and working on capitalizable functions. So we've got a little bit of number there. So when you add all that up, we are $75 higher than the industry averages, but I'm going to show you it's future-proof and fewer outages. The bottom section here, actionable cost drivers. We have some, where we are in our business, particularly with enterprise and MXU, starting up that part of our business, we've taken advantage of some efficiencies. That work looks a lot like activation. It also looks a lot like build. And so as we are taking advantage using the same workforce, going out there and doing these types of work, sometimes parsing between what is middle mile, last mile, and activation CapEx, you know, it's an area that we'll keep getting better at. But more importantly, that second bullet point, delayed activations from partner, third party, and also the very same MDU or MXU, that's multi-dwelling units, apartment buildings, sorry. When we spend that money, it looks and feels like activation CapEx. Those customers come to, and it's a 100% investment in the customers to come. And so it does take us time to get penetration rates in a multi-dwelling unit where we may have spent a lot of capital to equip every unit in those buildings, okay? So those are the two biggest drivers of what we're looking at. When we report this way, it does make it look like we're closer to $1,200, but for activations. But when we look at the actual very specific tasks that we perform for activations, we're a little bit higher than the industry, specifically because we direct bury or because we build conduit. So
I just want to jump in on 2 points because Jason bears the brunt of it, and I feel like it's primarily accounting, so he shouldn't have to explain it. There are 2 bits in there. One is, we are fully loading, and maybe others are, maybe others aren't. We don't know. We didn't do an extensive kind of, evaluation of everybody's accounting policies when we developed ours. But there's an inefficiency that we fully load. So that means somebody's sitting around doing nothing. You've inefficiently planned your labor, then that just increases the cost per. That, you've heard me talk about scale and efficiency. I think neither Jason nor I feel we're at tight efficiency in our scheduling at this point. But I'm going to connect that to something else he talked about, which is the partner networks. We are, all of you on the cap table know that we are a good partner to the people we work with. So what we have done, and have only really this quarter, like when I say that Q1 that just passed, started to do, we'd go to our partners, we would say, what's your estimate of build? And they would give it to us. We would staff accordingly. And then this quarter, when they came in there with their projections, Jason lives in North Carolina, but the whole company is so deep in Canadian culture, and they don't push back on their partners. It's like, okay, will this be the first quarter that one partner meets one prediction on time? And it was, me pushing back, just saying, like, no, we can't keep, they miss every single quarter
every single partner. And I will say, you know, some are better than others. And so any of you partners out there listening, you're one of the good ones. You know, but that drove real dollars that sit in the accounting that look like cost per install. It's an example of the efficiencies. Now you can get on to explaining the rest of it, but I just want you stuck with that.
Thank you very much. So I'm just going to tell you a little bit about why this is great, why we're doing it this way. Should we do it this way?
I have one question from Sydney Van Verizon. Are there capital costs associated with MDUs beyond connecting the structure, rewiring units inside the building?
Very good question. So generally speaking, the industry and team have been taking fiber to every individual unit in the MDU. I love spring. It's planting season. That's actually me on that tractor with my grandson. Pay attention. He'll show up later. What I don't love is when a gardener does this. This is a broken cable. It happens every spring by the thousands in some cases, just from people planting a flower, and it's painful. But I do love summer, lakes, etc. Or do I? You know, this was Raleigh, North Carolina in the late 90s, devastated by a hurricane. It's only gotten worse since then. You could move to Nashville, but if you did, you might experience this from tornadoes. But hey, I love winter. That's me skiing, but not that part of winter. That makes me want to eat, stress eat, and I do love risotto. But unfortunately, these little boogers, they love to eat fiber cables. So how do we build it to be resilient? We build it underground, as much of it as we can, in conduit, including that last connection that I was talking about from the curb to the home. So can we measure its performance? Well, in my past, the way that I planned for repair and maintenance volumes at the end of the year, preparing for the following year, these are the types of volumes that I was dealing with, projections. In the red line, you'll see an all aerial network. You'll see massive spikes in January and February, also during the summer months or the late spring and summer months, and then also in the fall, all related to those things that I just showed you. Is it ice in January and February? Is it the planting season in the spring? Is it hurricanes in the fall? They all happen. And so that was pretty challenging. The black line there is, what if you flip it all underground and but don't put your service drops, the connection to the home, in conduit? It looks a lot better. The black line does, but it's still in some cases 10x the volume during the spring and summer months. So come to Ting, and at Ting we've been putting drops in service connections and conduit. And this is what it's like for me to plan for volumes. It's the dashed blue line there at the bottom. It's taking me a little bit of time to get accustomed to this, but I'm watching the performance data, and it is really how well this network performs. So from an operating cost perspective, you can imagine how much easier it is for me to plan, control, manage the functions, the tasks, and the spend for this. So how we build it means fewer outages, lower costs, better operating costs. This will be the lowest operating cost network that I've ever managed. I do love cars, electric and hybrid. I love this Polestar. I've driven one. I might get one day. But right now I have a hybrid Lexus in Toyota, the Toyota Lexus model. Why? Well, Polestar's got some QC concerns. They'll get better. I believe in them. I do, but not yet. Meanwhile, Toyota Lexus, 8 out of 10 most reliable hybrid electric cars in the US, these models. And the market rewards reliability. Toyota has overtaken General Motors. Everybody loves them. Everybody loves quality, especially in our business. These are just snapshots from headlines. I didn't type them, but they're all true. If you let your brand be defined by low customer service or low quality, That is, as Elliot puts it, no matter how many showers you take, it won't come off. You can change your name, you can pull a lot of tricks, but people will remember. So how do we make sure we build it right? So we developed a QA/QC program. We built standards based off of what we've seen and proven to be most effective. We train our internal and external resources to those standards, and then we watch it, we inspect it, we take pictures of it, and at the end of it, we test it. Can we measure it? Well, in our business, bad QA/QC shows up like this: delayed installations and missed revenue. That is a killer. Labor-intensive network maintenance, poor customer experience, CSAT numbers would suffer and your churn would go up. And we would have unpursuable warranty claims if we don't document what's happening when we're building it. Or worse, this is a real headline from Durham, North Carolina, where people were injured because and killed because quality control measures were not being done by a fiber optic builder. So how do we look on these metrics? I think they look great. Missed revenue, we're not missing it. Sub 1%. Our damage rate, 0.2 per 100 customer outages, is so low. It's every 2 weeks I review our operational metrics, and I just keep digging in, thinking, where am I going to find the damages? And I just can't find them. Our CSAT, stellar. Our churn, Q1, down to 0.6, amazing. Warranty claims unpursued, we had one in the last 2 years, and that's incredible. And we haven't had any of those human health and safety issues. So program's working. We are making the internet better. Now, I told you my grandson was going to show back up. I love Lance. Lance loves rockets. Amazon delivers rockets same day. Therefore, I love Amazon. Most of you know that Amazon built their own delivery platform to get their products to the end user. My point in saying that is when something is really important to you, sometimes you'll do it yourself. Related note, just from a few weeks ago, that $42.5 billion investment in high-speed internet, the industry is starting to shudder under the burden that that's putting on a particular workforce, fiber technicians. So who builds it for us? Well, we use a lot of contractors for the heavy lifting, moving machines to move earth and put things in holes. But when it comes to actually splicing the network, putting the cables together is such an incredibly important thing. These are the people that the industry is saying, we don't know where we're going to find them all. Well, again, 1.5 years ago when I came to Ting and realized that this company had invested in the programs, the training, the staff, and the equipment to perform this mission critical function, I was very pleased to see it, and we have leveraged that. We have put a few things in place to make sure that it'll give us the results that we want, standard procedures, train internal and external staff where appropriate, field-based OJT, competency tests, and a QC program. Okay, these things, very important. Can we measure it? Well, not everybody's meeting their goals, and there are a lot of reasons for that. But I will tell you that my history has shown me that if you can solve that last little bit, the splicing of the fibers, you have your best chance of meeting your numbers. And we're meeting them, we're beating them. So is it all worth it? We deliver on time. Revenue retention is there. Put those two things together along with low operating costs, it's going to give us the best securitized net cash flow. So that's my section. Do you have any questions?
I think that was such a steaming presentation. The fire department. Yes, Bentley Cross again. Can you spend some time walking through why Ting uses microtrenching? You've lauded the benefits before, but some competitors have downplayed its use.
How much time do I have? Well, so for the sake of time, I will try to keep this brief. Microtrenching is wonderful in high density areas. By that, I mean tightly compacted residential areas where homes are very close to each other, and there's a lot of concrete sidewalks that are connecting them or in front of them. So think of Alexandria, Virginia. That is a perfect example of where microtrenching would be great, because we would not have to dig up all of the sidewalk panels to put cable in. Instead, we do microtrenching out in the street. So just generally speaking, there are certain types of cities where microtrenching is very appropriate. Contrast that with markets like North Carolina. We don't do microtrenching in North Carolina because just the topography is more conducive to traditional.
That's it.
Okay.
Any other questions?
Two quick questions. You're changing contractors, as I understand it, the partners that you're working with to build. I just wondered if that would include like Dicom or Mastec, about the biggest players there.
Let's see. So we definitely work with national vendors like Dicom. And of course, Dicom has different subsidiaries underneath them, and we work with several. We have worked with several of them, and our vendor selection choice is going to be based off of geography. It's going to be based off of who's got the right staff in the right place, and ultimately what kind of best cost we can get for the work. So it's definitely an ongoing vendor management strategy that we have on that front. I'm not sure if I answered your question.
Yeah, that's correct, Jason. And then secondly, quite separately, given your experience, having been in ILAC and cattle company, what's been your observations of aerial rollouts? I think Alec mentioned, or Metronet's an example that's done some aerial, much faster to deploy, much higher OpEx, obviously. But you've got 36,000 customers now, and what do you think you'd have if it was an aerial network rollout at this point?
So devilish details there, right? When you're building an aerial network, the level of pre-work that must happen from an engineering and what we call make-ready construction costs, time and cost to make that line ready for a fiber to go into the air. A lot of people don't track that, or more likely, you would build aerial where you can get that done in the fastest possible time, the shortest amount of time. That does limit your footprint. You'll see that a lot of people like Metronet that are building a lot of aerial network, some areas move far faster than others, right? And so it's just not ubiquitously faster to build aerial.
Because I know at C-Spire, they were just shocked that in some of the smaller Mississippi markets they hit, that they were getting 50% penetration. And that's quite interesting, isn't it? The smaller rural market would offer such high penetration.
It's not surprising to me. I live in a small rural market, and everyone I know would, well, I will call that differences between like a municipality, like a township versus, long, very remote rural.
Is that because there isn't coax? Did fiber skip coax in those markets?
Yeah, in the US that happens pretty frequently where smaller towns don't have coax.
You go from dial-up to DSL.
Yeah.
Sometimes, but you have chunks of big cities that don't have coax. Okay. Like if the coax plant in the let's call it the digital divide parts of most big West cities is disastrous.
If you go back a few slides, one of the itemized slides, I just did it like a 350 kilometers of actual. I just want to make sure that I understand what that is.
Yeah, sure.
Is it the bottom piece?
Yes.
In the install?
Yes.
Yeah, so you can go, yeah.
Yes.
So I'm gonna, again, I think this is the business burdening the construction professional, right? You've got things like labor inefficiency, right? So imagine you've got capacity in a footprint for, 10 installs in a day, but you're only going to do 5, right? You still have all those costs. I'm not paying
downside to insourcing your installs is you better be efficient in your scheduling, right? And we were calling out that as, one big bucket of example. And then I'm adding to that the fact that our partners, in the partner networks have never delivered to their, and look, I don't, we've been, I've had to, deal with the construction business now for, it's getting close to 10 years, well, no, not really, I guess 7 or 8. And, it's a tough business, it's I'm used to, I am, in the internet business, I'm used to normally distributed errors, in the construction business, they're all on one side, they're too much and too late, right? So, those things at an accounting level burden it. The other piece is we burden it with our head office costs, right? So, at an accounting level, it's an accounting policy that, that I'm going to say we've chosen. I wasn't personally part of the decision, but
that's just a function. Right?
No. Look, take a step back, right? Like every, there's not 10 public companies of our size where fiber is the, kind of the biggest, meatball sitting in there, right? It's such a big part of our business and our cash spend. When you see it inside of Frontier or AT&T, who are public, it's buried. They break out nothing for you. So they can give you a cost this is my cost of a marginal install, right? They're not fully burdening that. They don't need to. It's going to be a little, a sort of a footnote in a presentation that somebody speaks about. The people who are like us are all private equity backed. So when we're getting compared to benchmarks, right? It's all going to be, sort of things that are not nearly comparable on the public side, or, it's people swagging numbers that are not publicly disclosed or blessed, or, right? They don't have to define them. They don't have to sit in a room like this and take questions on them, right? Big part of the reason, and I don't want to keep coming back to it, but I will, that I really want everyone in the room to realize, that we are the owners of this business. We are those Dutch business people sitting around the table. That's who we are. I think that doing this in public is difficult. And, as long as we keep reminding ourselves that that's, really who we are, where we are, what we're doing, what those benchmarks are like, we'll be okay. Right?
I have repeatedly said that it's difficult to build this business in the public eye. Just 2 questions on this in particular. So first, in the video that you released the other couple of quarters back, it
was January. It was just the end of January, beginning of February.
You disclosed this number of
end of February, last quarter.
You disclosed this number of 14 million capex for installations.
Yeah,
and I would expect with installations much less of a time lag, or
it's not a time lag. What you didn't do, this is great, Marlena, she did the same thing yesterday. And when this happened, we all just looked at each other. A German will ask this question for sure. So what you're missing is the churn. So there's actually 14 million, 11 and change installations. It actually comes out, that was 1,200. I think it came to 1189. So we did this. I'm assuming that's the question you want to go back and So what you missed there is the churn, right?
We still gross ads, net ads. It's something different.
That's right. We can show you the work on it, but
okay, understood.
Yeah, but I love that you did exactly as we expected.
Well, that might be a reason for it. So the other thing, I mean, as far as I understand, you want to finish Alexandria within or in 2 years' time or something, or at least a big part of it.
I'll let
You've been working on it for quite a substantial amount of time already.
No. Well, we'll come back to that, but I'll let you get your
Well,
question.
it's been released as a city.
Yeah.
Month back.
Yeah.
So for us to better understand this, these timing mismatches, can you go into the rabbit hole and maybe talk a little bit of how much you've spent, for example, on Alexandria? Because I mean, there's hardly any serviceable address yet, but probably, I don't know.
Yeah, I like that.
Millions spent or not?
That's good.
I don't know.
Millions for sure. So that's good. Let me take that as a QA question, right? Because people, that'll take a little bit of a workup. But I like that. That's a great opportunity, really, even to a lesser extent, Colorado Springs, but not the same way, to make some of these points. So thank you for that. I like that.
I'm just curious, on the,
I got you.
the first point where you say the equipment, a lot of customers supply their own routers. Just curious, what's the reason that in those markets that's the case? And
So this is, you can, yeah. This is, there's even some funny backstories there, but historically, telecoms did two things. They forced you to use their equipment, and their equipment was crap. So there is, what do we get? We, of course, get a disproportionate amount of early adopters. Early adopters are geekier. Early adopters come in with a preconceived notion that this equipment's going to be crap. So we, from the beginning, because, we fancy ourselves, not like the rest of telecom, have allowed people to put in their own routers. That use their own equipment. That creates problems for us. When somebody buys a gig service and has a router that only has 100 meg port out the back and is screaming about your throughput, that's got to be dealt with. It is more difficult for us to troubleshoot on that third-party equipment. But if you say, why do we do it? It's really cultural more than anything else. I'd love to be able to wave a magic wand. We think the Eros we're providing are the best. We provide them because we think they're the best equipment in the market. It's what I use in my house. And until I got it up in my house and saw a mesh actually work well, we weren't going to use it externally. And that was true for other geeks in the building, right? So, but there is a natural distrust of telecom, which I not only appreciate, but share. And so, that's the story. And did you want to add anything to that? Okay. No.
So my understanding is that you guys, in some of the towns where you've been building for a while, most of the CapEx is already done.
Yeah.
However, can you talk a little bit about that and maybe a Q&A questions from like how much of the completion of CapEx per town, from how much should you spend 100?
Yeah. Yeah, so we can only do that in a couple spots, because in North Carolina, in Colorado, I'm going to drag you guys down into the accounting system in a second. But in North Carolina, in Colorado, certainly in Arizona and California, we still have a lot of building to do. That's really what messed up. I know you guys, a lot of you were traveling, but that's really what messed up this whole kind of mature and growth markets is definitionally, they actually still have a lot of growth in the mature markets. And so that's kind of messed up the numbers. So I've got to figure out how to retell that story more effectively. So there are a couple places where we can do that. And we can see whether that, adds something. What I would tell you though, because I really, this is a point I thought about making earlier, I'll make it now. Again, I'm back to the Dutchman sitting around the table. We always
had shareholder representation on the board. Raleigh and I were the two biggest shareholders for years. We were on the board. As Raleigh transitioned out, Marlena transitioned in representing a big chunk. Lee is now going to, I asked you guys, you didn't, okay, yeah. Lee is now a board observer, will be standing for election in September. That's a big chunk. If you want to give me credit for the friends and family who are around me, that's over 50% of them in there. So there's two things. One, we're going to do the best we can publicly. Two, look, I think this is an owner-run company. Those people are seeing the inside numbers, right? So it's going to be a balance. Look, one of the hard things about doing this naked in public is there's a lot of competitive information, right? There's a lot of we have to telegraph our plans to our competitors. I wish all my competitors were telling me what I have to tell them. And so we're going to do the best we can to show those numbers. I have no problem, with that suggestion. And sometimes you're all going to have to be a little bit comfortable that the people that are there who are seeing everything have your back.
Sorry for this follow-up, but I wanted to ask one more question on the installation numbers. So yeah, we have this 40 million capex divided by the gross adds, but that's the capex chunk of it. Didn't you in the past also mention that a large part of the OPEX spend is actually also related to installation?
That's part of that attributed number, that head office number. And I don't know, George or Dave, do you want to add anything to that? I don't know if there's.
Well, the question on is there all I think what they're going to do is a one-time OPEX associated with installation, which is not necessarily like actually installing, but customer acquisition costs. Whereas.
Oh, are you talking about my comment that such a huge percentage of the OPEX is for new customers?
Yeah, it's just, I remember you saying that it's related to new customers.
Yeah, so that's much more about CAC and customer service. Yeah, yeah.
The gross ad number, you're right on.
We're good. Yeah. Yeah.
Okay,
Sorry.
I think we're
Thanks,
ready
Jim.
to move on to
Okay, good.
Michael Goldstein.
Great. So
It's not a few slides. There we go.
I don't have any grandchildren, so I'll be quicker. So the part I'm going to talk about, the part that I oversee, is the penetration. So if I go back to Elliot's original assumptions, my job is to drive this 20% in 1 year and 50% in 5 years. And a lot of what I would tell you about has already been said. Elliot said that the incumbents that I'm stealing share from, nobody likes. Jason told you that we're building world-class networks. And so predictably, we're really marching very nicely along this curve. And I'm going to show that to you from a couple of different angles. This is sort of a top-line view of it. And it blends together all markets. So you've got markets here that are in their fifth year, or addresses that are in their fifth year, and that 50% share. You've got serviceable addresses that have gone live in the last couple of weeks. But what you find is the green, well, I'll say the blue first, is your serviceable addresses, and the green is your revenue. And it's been amazing how consistent the relationship has been between those two. Basically, every time a serviceable address goes live, well, it's not every time it goes live. What happens is addresses are going live, addresses are maturing, but we have stayed locked in pretty much at 30% share of our serviceable addresses, and then pretty much at $90 per customer a month. And so our revenue per serviceable address has been almost locked at that $27 every month for the last few years. So super, super reliable. When I think about what we do in these markets and how we're driving this penetration, there's really a couple of themes for me. One is top to bottom, building awareness, all the way down to driving the order. And these towns are a great size where we could go in and really surround the community. So we're getting naming rights on the largest music venues, and we're doing partnerships with nonprofits, and we're hosting classes, and so really in a lot of creative ways, we're really infiltrating these communities and surrounding them, and then all the way down to driving that order. We've got a great door-to-door sales program. We've got promotions we're doing every quarter. I'm always looking for the upside, and for me, when I look at this funnel, there's real upside in the middle of the funnel in terms of consideration. And there was also mention of our new platform and how much more sophisticated we're going to be getting on the website. I'm really excited about more lead capture, more CRM, more opportunity to get those people who are stuck for one reason or another with their existing providers, figure out what hurdles we need to clear there and get them across the finish line. The other theme for me is balancing what we do centrally and what we do locally. If you do things too much centrally, as the large cable companies tend to do, then people feel like they're buying a national product, and it doesn't feel like what you're offering them is particular to their community and to their needs. If you do things too much locally, then you're operating inefficiently. And I think we've done a wonderful job of having a central group that is developing messaging, gathering insights, building promotions, but then taking it and localizing it in every single market. So if you look, and most of you can't see it, but the most recent creative we have in the yellow is really highlighting the people who live in your community and the people you might see around town. And it's a centrally developed campaign, and then it says, insert the people here. And by the time our local prospects see it, it feels very much like it was designed for them. So this is the view that I stare at pretty regularly. That gives me a sense of how we're doing on that path to 50% penetration. So what you see is on the y-axis on the left is the penetration, and then the x-axis is what we call average years serviceable. So again, in any given market, you could have an address that's been serviceable for 5 years, and you could have an address that went live yesterday, and so you're at an average of 2.5 years. And so what you see here are all our towns represented. What we've discovered now, having been in this business for a few years, is it really jumps up even faster than we might have expected in the first year. So we're really doing better than 20% in the first year. So it's very much, for any Crossing the Chasm fans, very much that early adopter sort of dynamic. And then we've got a more a consistent, slow climb from there. And I'll show you a different view later that gives me a lot of confidence that some of our mature markets are still climbing in a way that is more linear than it is plateauing. And by the way, just to give you the aggregate on all this, we are at about 2 to 2.5 years average serviceable across the entire footprint, and we're approaching 30% again in terms of our market share. And when I look at each of these towns, there's just a ton of stories, a ton of lessons in each of them, situations that have propped some of these up and really driven them that we want to replicate, some opportunities that are or situations that are holding them back, where I think there's opportunities for us to get better. Certainly the selection of towns, there's so much there now where we could look at a town and say, yeah, this is the sort of town that's hungry for what we offer. We refer to fiber lust. We've done really well with towns who lost out on fiber. They lost out on AT&T. They lost out on Google, and they were just begging us to come. And those are places we know we're going to do well. We've had at least one town where we say, that was really just one ambitious council person, and the rest of the town maybe wasn't totally bought in, or they're still asking us about traditional cable packages, 5 years later. And so we recognize now where you have that sort of progressive, technical sort of culture that we'll do well in. One thing that I'm really excited about is what I call cluster buzz, where when we've got a couple of towns that we've done, and then some ones come in nearby, we jump right out because we're already benefiting from the awareness we've built there and some of the jealousy. A couple of other lessons is that the faster we build, the better we do. So if we build slowly for one reason or another, then there's people who were excited about it a year ago, 2 years ago, 3 years ago. We're going to have trouble converting once those people are serviceable. So again, you've heard Jason, you've heard a little bit about microtrenching. I'm very excited about how that speed translates to conversion. And again, Elliot had shown this map. So much of what we're going to be doing leverages, what I've seen as best practices across the country with those clusters and with the right sort of psychographics that we're choosing. And then this is a different view. This, rather than show you a moment in time, this shows you each market and how it's grown over time. And in this case, you need to have a denominator. So I'm using what I consider to be the market at scale. So this will be lower than the share that each of these markets at of their current serviceable addresses. This is where they are relative to their future serviceable addresses. And what I look at when I see this is I see markets that are not growing to my satisfaction. So it's a great view for me to say, that one's plateaued a little bit. What can we do there? What's going on? What I get very encouraged by, and I mentioned this earlier, is if you look at some of the more mature markets, the ones that stretch out furthest to the right, you see that they really don't look like they're plateauing at all. So these are markets that are, among their serviceable addresses are over 40% and are really, really still growing in a pretty linear fashion. And finally, some upside. For me, we do a great job building awareness. We do a great job building consideration. I've got some very easy opportunities coming up to convert way better once people get down deeper into that funnel. One is simply the opportunity to optimize our purchase path. With our platform we've been on, we've really had very little flexibility to do a lot of A/B testing and a lot of iterating to the site. Say, what if we put this bit of copy here? What if we make this change to this button? What if we shorten the path in some way? And I think there'll be some easy wins with that. With the Affordable Connectivity Program, again, you've got awareness that goes out there. You've got people who come to check us out. Now we're going to be able to say to anywhere from 10 to 40% of the population in different towns, boy, if you qualify for ACP, if your household is at 2 times the poverty level, you could be getting our best speed for free. So there should be some easy incremental acquisition for us. And finally, the major one is really mobile. I won't go too deep into how we got here, but many of you know we had an MVNO, a mobile business. We still have a deal with Verizon and a commitment to Verizon. And what we're doing there is we're just making it this amazing complement to our internet service. So people who have been wrestling with leaving their incumbent cable provider to come to us and get our fiber internet, now are being told, by the way, if you're a Ting Internet customer, you can get $10 unlimited service on Verizon every month. And so that suddenly changes the equation in a major way. And we've been watching Spectrum have a lot of success with this, and we offer a better experience, and we've got a better deal. So it should do a whole lot to help our conversion on internet. Questions?
Just to remind everybody that's listening online, if you have a question, in the lower right, there is a chat box. And if you hover over it, it says chat with everyone, and open that and you can type your question.
What's the relationship between the dots, the size of the dot, the location of the dot? Are you ready?
Yeah.
You've done contribution from those dots.
Sure. Well, the size of the dot is easy. The size of the dot I should have mentioned is the amount of serviceable addresses.
So a small market positioned on the top part.
Yeah.
Above the line, right?
Yeah.
The size, okay, because there's fixed costs with entering a market, right?
Mhm.
So the size and penetration rate, so, right? So you want a big dot off to the right.
Sure. There's not, and maybe you could talk to this, that there certainly are efficiencies, but a lot of our costs are to acquire customers, cost to acquire a customer, cost to service a customer. And so there's certainly markets that would be too small where we'd say, boy, even to put one marketing person in that town is inefficient. It's too much marketing person per town. But for the most part, I don't consider our small towns to be terribly inefficient versus our big ones.
Okay, so there's none of those dots, regardless of where they are on that, you look at, except for if they're in the bottom left-hand corner.
Well, bottom left-hand corner is not a bad thing because it just means you're young. It just means you've just started growing. So
Bottom right corner is the worst one.
that would be terrible. Yes, that's it. And that's what that line should represent. So if you've been around for a long time and you're not climbing in terms of your penetration, that's where it's a problem.
And how does that chart inform your marketing? Like,
Yeah, sure.
Back up.
Yeah, I mean that's showing me where we're overachieving or underachieving, and so when I see markets that are lagging behind there, I'm diving into, okay, do we have a competitive problem there? What's the competitive message we're competing with? Okay, we're competing with someone who has this fantastic offer in the first year, and then it jumps way up in the second. We've got to get better at combating that and talking about that. Do we have a community that is not necessarily technical? Maybe it's older. Okay, we've got to teach them how to use some of their streaming options to be able to say goodbye to that traditional cable package and come take advantage of our internet. So it just flags potential problems for me.
Last question.
Sure.
The relationship you have with Verizon at $10 RVP, does that alter the churn curve?
Just because where I jump in is where I don't want the poor operator to be burdened with the, sort of the stuff that I dump on their desk. And so, we're early. Actually, I mean, you could talk about how long you've been marketing it, what you're seeing so far, but really until the new website lands, it's so painful right now. It's hard for Michael to sell. It's hard for Ross to instantiate and provision. So, you can talk about length of time, et cetera, but so it's all to come. You're going to be hearing us talk a lot about it going forward.
Yeah, and the answer is it certainly should encourage customers to stay with us. You'll just hear us talk more about customer acquisition because there's so much more upside there. So few customers leave us now that it's tough for us to calculate what huge gains we could have on the retention side. Did I see someone else?
Okay.
Okay, thank you, Michael. Yeah.
Introduce
Well, here's Ross. Ross was 2000 employee number one. And he's been doing it for a long time. And I should know, this was Jason's first time doing anything like this. Michael has spoken with a bunch of you before, so I was really doing that, now that we've done it, you can clap for it. Oh, and you can figure out there's other classes that come to the mic too.
That was the best intro you've given me in 30 years, Elliot. That was great. Thank you. So you've heard a bit about how hard it is to build the network, great work Jason and his team are doing. Michael and his team are working really hard to make sure that he's selling into that network. I'm really going to talk to you about the work we're doing to hold on to those customers. And it's tough to talk about something that isn't really happening because the customers aren't leaving to an appreciable degree, but I'm going to talk about some of the dynamics there and why that is. You saw this in an earlier slide. I've highlighted here the key assumption around our churn Do we want to stay in the range of 0.5, 0.75? If we can get it to 0.4, 0.3, we're thrilled. But certainly, kind of keeping it within those bounds is job number one for me and my team. The work here is actually pretty easy, because if you think of the modern telco market, it's a pretty hostile place, right? There's so many things that the incumbents are doing to antagonize their customers with contracts and gotchas in their pricing and install dates that may book out 4, 6, 8 weeks at a time, and crappy CPE, as Ellie was talking about earlier. And within that market, Ting's a bit of an oasis, and we get to be an oasis because all we're doing is not doing the things that our competitors are doing to a large degree. And so I just want to talk about, I'm going to be quick because I know we're getting short on time, and it's tough to do a full 30 minutes on something that isn't happening, but I do want to talk about some of the things that are happening here. These are all the inputs as to how we get to that low churn. And I'll share some stats after this. Really all hinges around a great customer experience. A lot of that comes from the people that we have in the business and the operations. That falls in the label of great customer service. Jason's got his field team in-house. We've got our customer service team in-house. Today, that's about 120 or so people, all working throughout. We got a lot of people in our local markets, a lot of people here in Ontario, just because of growing up here. And we find that finding good people is hard. So we have a really strong talent management strategy around the people that we're bringing in. We do a lot of work with our people practice to make sure that we're recruiting strongly. And we find what works best is that find curious people that like helping others, and we can train on all the ins and outs of being a fiber operator. So we put a ton of time and energy into supporting them, developing them, helping get them up to speed as quickly as possible. But all of that's done in-house. And what that means is that we're able to offer one and done service, no matter what customer segment we're talking about, whether it's a residential customer or a commercial customer, by putting smart people in front of them. None of what we do is scripted, for example, because we've forearmed them with knowledge about how the CPE works and how the network works, and the difference of some of the on the ground issues. Not every market is identical, so they got full visibility to that. They've got full visibility to the network telemetry, what's light levels coming off the wire, and we're always iterating that, creating more visibility to these people. And that just puts them in a position to be as helpful as they can be, and we trust them to be helpful. There's not a lot of what I would call gates around their decision making. For instance, each one of our people on the phones, frontline customer service advisors, been with us for 6 months. If they're going to spend $200 to solve a problem for a customer, that's fully within their discretion. Above that, we kind of say, ask a friend. Don't go, out spending crazy money on solving individual problems. But all of that's monitored in arrears. There's no, they don't have to put somebody on hold for 20 minutes to get a supervisor to sign off on that, right? So that alone reduces our costs. And of course, we can monitor that on a weekly and monthly basis, make sure those costs are within, our expectations. But it's just one example of one small thing that we do there to, really keep those people solving problems as effectively as we can. Another big part of a success here linked to our low churn is just that community focus. A lot of our people live and work in these communities that we're serving. Super helpful when you're staffing a table at the farmers market and pushing the Ting brand with Michael's colleagues, to just have a known face there, right? So that extends into a lot of areas of the operations. And then of course, there's things like our approach to our contracts and our pricing. We've kind of got 2 SKUs, $89 for residential, $139 for SMB. Of course, you can buy more if you ask nicely, and we've got a way to deal with that. For by and large, we're not offering contracts to our customers. We have a terms of service, of course. If you really want a contract, we can give you one. You know, we do have some commercial customers that like that. But that all adds up to, some really, really good outcomes. So you can see here, the biggest measure that I keep an eye on day to day is our CSAT levels. Last year, we managed to finish off with an 88. You know, the gold standard for telco is in the 30s. You know, I've seen scores in the minus 40s. So there's your range. But then that all shows up in our churn numbers, right? So you can see here our average churn for our core markets was 0.77 last year. This year today, we're at 0.57, right? So you can see we're well within our bounds there of taking care of these customers and making sure that Michael doesn't have to work over to find more customers than we're losing. That was it for me. Any questions? Go ahead.
Thank you, Ross, for the overview. Just two questions. When you say churn, that's customer churn, not address churn, right?
Correct.
So you would assume that, say you lose a customer because that'd be mainly people moving, I suppose.
They move or they die. Those are kind of the
Move
two
or
big
die.
reasons. Yeah.
Now, do you really have to win back that customer? Because whoever moves back into the house, there's probably keep the fiber, right?
Yeah, absolutely. There is a win back process in place for that. That's something we want to get better at, but there's definitely opportunities there to relight that address for sure.
Okay. And then
Just quick thing, there's a much, Comcast, Charter, et cetera, have a much deeper practice in that move because they were likely to have been on the other side of the move. So when you're canceling, they will say, where are you going? Oh, you're moving from this market to this market. Well, we are here or not. We believe that Cox, Charter, and Comcast all share that data. We've seen them share data in a different context like this. And so we're at a disadvantage there, right? Because we've got to do it through the lever, like the person who's leaving rather than the person who's coming in. But so all I'm saying is they're ahead of us.
Sure.
We think there's a lot of room for
I'm obviously
improvement.
asking from a modeling perspective and kind of, is it really appropriate to model on that churn additional customer acquisition? Or is it just
we
really replacing the
don't.
customer?
When you saw that in, for instance, the atomic unit, we have an assumption of 75% at maturity at 50%. You're 75% likely to get that customer. That included, therefore, I don't think we changed the CAC assumption, but we did change the install assumption.
Okay. And second question, you have 88 net promoter scores, fantastic. You see your sales number come through kind of as expected broadly or possibly better. What does it tell you about your product price? It's a bit like you're selling a Porsche, to make a German reference here, which sells really, really well. Everybody's really, really happy. And everybody's like, this is a great price. Just ask something like, why not more expensive?
Totally, it's a great thing. I think, we'd like to think about it as value positioning, not as premium positioning. But certainly, I think customers' expectations for the performance are less than the actual performance they're getting. So they do get that Porsche experience post-purchase, right? So just, that kind of goes to decisions 30, 60, 90 days out, where they're actually quite happy with the product beyond what they.
But you can also argue 88 net promoter scores, like everybody's really, really, really happy. You almost want like two mentions of people who say, I'm really happy, but it's really expensive.
Yeah. And I would tell you, we have a bigger problem with staff in this regard or employees than we do with customers. Because our employees are so customer focused that if there's one person who thinks it's too expensive, and there always is, immediately we should be lowering the price across the base. So, we don't get a lot of external pressure. And by the way, our pricing is sort of on par with cable, and with the mobile bundle is cheaper. And so they certainly have some first year lower, but with mobile, even with that, with mobile, once you get up into 2 and 3 lines, we're less expensive.
Okay, I have, oh, sorry.
We continue on the pricing question. Understanding is from our last call that you don't model that price increases going forward.
Correct.
So how do you balance it out? Let's assume you continue to be in the market with 8, 9, it's nice price, and 93 some parallel. So how do you continue onwards that journey? And how do you balance it out with churn and something?
I just don't, like, I'm not sure what you're asking. You tell me if this answers it. My best guess is our price will be 89 for the foreseeable future. I expect that a gig will become 2, will become 5, will become 8. I deeply believe that this is infrastructure. I think that telephones were priced as a price for a phone line. Cable was priced, because it's entertainment, as small, medium, large. Makes sense with entertainment. It does not make sense with utility. To me, what somebody is buying when they're buying internet is just, my favorite laptop sticker ever was fat pipe, always on, get out of the way. That's what you're engineering. And, we don't talk about water or electricity in the context of small, medium, and large. We're a little bit dirtier. Still,
you use more kilowatt hours, you will pay more.
Some, you've got a little bit, but there isn't, that is certainly not part of this pricing. I'm talking about the product, not the pricing, right? And, there is no, we know, and we've learned the hard way in Ting Mobile, and don't make me go back there, that utility pricing does not work. As one of the leading behavioral economists in the world said to me, imagine if you bought your meal per bite, your utility for the meal would go away. That's where we are in telecom. I'm not going to change the world with our little seat. There's one online. Hold on.
In fact, from Ireland, Alex Fortune wants to know, how does churn evolve based on how long the customer has been with Ting? And apologizes for not being here.
It just settles out really nicely. We find you're going to see most of your churn in the first 30 days. I don't know what I'm looking at here. I guess the camera. I was looking at Monica. I'm all confused. We're going to see more churn as a customer moves through that onboarding experience and into steady state. But then long term, it just settles in nicely. And unless they're planning on selling their house or taking a fatal drive, that they're going to be a customer for a long time.
Numbers cross churn. What would the net churn after kind of
Oh, no. Because those are different customers. It is the same address, but the customer is the,
Great, thanks.
Thank you, Rob.
Thanks, everyone.
Great audience. Okay, so good news. We are finished with Ting, and we can move on. We do have 2 other businesses here. So first will be Dave Warwick to walk us through the domains business. And when I say walk us through, just kind of tell us where things are at. I know you all are deeply familiar with this business already. Yeah, sorry, not Dave yet. I apologize. I did want to add a couple things. I did want to add a couple things to the Ting piece, and I'll fly through them quickly. Look, I think that everything here is a little bit of upside that is not fully modeled in because we can't yet. First thing I want to talk about is ACP. This is the Affordable Connectivity Program. This is a U.S. government program that may or may not get whacked in the
sort of the debt ceiling and some of the budget perturbations, but, you know, we believe it's going to stay in. This is, we have the best offering in the country for that $30. We give the full gig. If we go to 2 gigs, that'll go to 2 gigs. We give that product to anybody who qualifies for the Affordable Care Program. That means they are essentially getting it for free, and we have the government as our payor there. We can't model this. We think we can make money on this, on these units, even on these units. You remember we talk about a more than 95% product cost or contribution margin on the gig, you know, so that goes to 85% when you take the price down by 2/3. So we still think that we can make money on the marginal unit, but we need to, you know, it's speculating about things like what the penetration assumption is on a free product where it's underserved. That's going to need a lot of product knowledge. Really, really difficult. So we're going to do that in market. Mobile, again, we really haven't seen this manifest. We won't. I don't believe, I'm not going to be judging this, even starting to judge it for another 60, 90 days. But it's an amazing offer. $10 unlimited on Verizon for anybody who's a Ting customer. $20 unlimited on Verizon for anybody who's in the Ting footprint but is not a customer. That is a best in country offer. You know, we are turning this commitment we have with Verizon into some CAC. This is not a, you know, when we get on the other side of that commitment, obviously we're not going to, you know, be offering that $10 forever. But we believe, I believe, and I'm deep into this, and I believe that you're going to see the mobile market in the US settle at the $20 to $25 unlimited range. I think that's what you'll see in 3 to 4 years. There are a few offers that are in market. You know, we've got our offer in market. Dish's offer is, I think, $20 right now. Maybe it's $25. Mint Mobile has a $20 or $25 offer. There's a couple others. The average price that a mobile phone customer in the US is paying is over $50. That means for everybody at 25, there's somebody at 75. There is a lot of air to come out of this balloon before this all settles down. So we like where we are, which is kind of below what the bottom is going to be like anyway, and then the market can come to us. I know what I think this is going to look like in 25, and I think we'll be in market at around $25 unlimited, and we'll be able to make a few bucks on that product. And, you know, really it's there. I could talk about other things through this part of the cycle. You know, I'm not talking about enterprise today. I think that you're going to see enterprise on a relative basis. In other words, as a portion of our business, get better from here, from where it is. You know, there was the great question earlier about VAS. Are we going to sell other things to these customers? Absolutely. You know, have we modeled in a nickel? Absolutely not. So I think that there's lots of room for stuff that's outside of the model as we speak. And I really want to remind, you know, that growth is not a linear process. You know, this always happens in fits and starts, even for this business, which, you know, you saw Michael's chart. You know, this is the 5th business that this company has birthed, 5th successful business. You know, the number of unsuccessful ones is longer. 5th successful business we've birthed. This is the most reliable, predictable of them all. More reliable or predictable than any business that I've been a part of. And it's still not linear. So I just really want to remind of that. And now over to you, Dave. Thank you.
It's a pleasure to meet all of you in person for those that I have not already. I could talk about the business for hours. I love this business. I know I don't get to, though. But I thought as a way of an introduction, to myself and my journey, that I would show a slide, and Elliot has these pictures in his office. So I don't know exactly when they were taken. I don't know the intended use. That is Mike Cooperman on the right. At the time was our CFO. I do know these are not great pictures, and I don't know if they made it online or not. When I joined, I was 37. Mike Cooperman was 41. He was the old guy in the corner office, and I am shortly turning 61. So this is a 24-year journey for me. And there's a couple things that are really striking for me, beyond just, as you age, you have wisdom, but to have the luxury to have worked at something with a long-term horizon and to be able to build and have the ups and downs and enjoy the successes along the way. But that is really, it's been a wonderful opportunity. Have enjoyed it immensely. The other thing is you appreciate what a blurring there is between yourself as a person and the company that you're part of and that you're working towards. It is striking how interwoven that has felt and been over the years. You grow as a professional and you achieve things, but it's always part of what the company is achieving. So that is really kind of my journey, and it has been wonderful to be part of. This is our company. This slide represents the business as it exists today. I'm not going to go into detail here because I truly appreciate how well each of you understands our business. The portfolio of brands that we have, the acquisition journey that we've been on for a number of years, and how we have rolled up a number of brands and integrated them into our business. You have an appreciation that we started out with domain registration. We've gone into some additional services. That's really setting up how I'd like to talk about the business today. And this, in many ways, reflects the conversation that Elliot and I periodically have, which is something to the extent of, Dave, like, is this business a block of ice that is slowly melting? Like, is that what this business has become? And why can't we have more success with additional services? These are the things that we banter back and forth, and that's what I intend to talk about. And that's how I'm going to orient the time that I've got today. To do that, it really requires me to spend a few minutes just talking about the channel. I really believe that this is a core asset that we've got in the business. It's been part of the reason that we've been and we will continue to be successful. It's the core of what the business is today. And I can't talk about where we are today without actually going back into the 90s. And it's wonderful as you put these slides together and you look at what sites look like, 1999, 2000. These were the two businesses that we had at the time. There was a profound appreciation for the business that we were in the 90s. It was a software download site. Business succeeded because we had 1,200 ISPs globally that were providing a local download. And it was the partnership with them that helped us appreciate the opportunity that we were about to embark upon with the wholesale domain business. It helped us to invent it. We have spent 25 years working with this kind of customer, nurturing and developing constantly in communication with them. We've grown as a business as they have grown. That is part of our DNA. And I always like to illustrate the point around our channel by telling a story. I pick a different reseller each time. This particular company knows that I'm using them and referencing them. They're ecstatic that I would pick them, that we as a company would pick them. And this is a great story to illustrate our business. Company started in 1999. The founder had a band and he wanted a website, and he found there were no tools at the time that would allow him to create a website. So he built it himself. And then in between touring, he worked at the record label where his music was published. And other artists asked him to build websites for them. They saw what he had done for himself. The realization that the founder had at that time was he very quickly needed to build an interface and some tools so that those other artists could do the modification of the site going into the future, because he just did not have time to do so. A few years later, he hired his first person into customer service. She is now the CEO of the company, highly respected in the music industry. The employee base of this organization is a collection of people that are passionate about music. They are musicians, they perform themselves, they may be involved in the music industry in another way, but they're actively involved in both the industry and this business. And sequentially, year after year, this company has just grown. As you can imagine, at some point along the way, they realized they need to provide domain registration, both as a registration as well as a management tool. And they partnered with us, and they've been with us ever since. We wouldn't find a better customer to have. And as they're successful, we continue to be successful. And if we understand their needs and grow along with them, then we are both successful today. And we have countless stories like this throughout our channel. Internally, we refer to this company as a vertical host. Today, everything you need as an artist to have a successful online business is provided by them. And it's one of about 10 segments that we have identified over the years as we look at and really try to understand as best we can our channel. We have hundreds to thousands of resellers in every one of these segments. That's a great diversification. We have 35,000 resellers, but many of these companies have their own network of resellers, which is in the hundreds or thousands themselves. And we believe that our channel scales to potentially 100,000 resellers globally through that multi-tier model. And there is both a mixture of large clients and the long tail. And we have equal contribution, just in terms of the margin as well as the impact and importance to our business that comes from our large accounts as well as the long tail. So it truly is the core of what we have leveraged to be successful. A couple comments about the channel, both the way I see it and the way that the industry would see it. It is of the highest quality that you will find in the industry. I really don't think that you will find a channel like what we have today and what we've developed. And it's an incredibly long tenured nature. The way that I define quality in this industry is we're selling a service, which is domain registration, but that is always linked to the usage of that. There is some service that is attached to it. It could be a website, it could be email, a variety of different services, but we generally don't sell a domain name through our channel unless it's attached to something. And that's great. That means it truly is in use. You don't see promotional activity through our channel that you would within other segments of our industry. Low price point, we're known as a premium priced supplier. There are less expensive places that you can get services, but that correlates with the opposite of usage, which is abuse. There are real abuse issues within our channel related to the DNS and some of the activity that goes on. That is non-existent in our industry. It actually makes it easier to manage our business, and it reinforces the quality. That's part of why our customers like being part of this channel. And then the last piece is that we have incredibly high renewal rates, well above the industry average. All of that feeds a cycle that this is a very healthy business that will continue on into the future. Makes it easier to manage, and it attracts the kind of partners that we would like. And those that don't fit left over the years. So I have a few metrics on here. I will tell you, having been in the business yes, we've got like 22,000 resellers have been with us for more and active for more than 10 years. I can think of hundreds of people and businesses that I've known personally all the way back to 2000 and 2001. So incredibly long tenure. It's also very, very low churn. Sometimes I'm asked about what kind of churn rate we have, how many customers are we adding, how many are we losing? Low single digit. So you can think of it as being at the low end of the long tail, limited number. We have about 1,000. We have about 1,000 resellers that are at the bottom that churn out, and the 1,000 that we add new year. So it's not a meaningful contribution to our business. It's part of the steady state. I talked about how we've got large accounts that drive an equal amount of business that our long tail does. So 5,000 do more than 100 transactions within a year. We've got 35,000 that do between 1 and 99 transactions. So very nice balance in the size of the partners that we've got. The domains that we have been registered for an incredibly long tenure. To 20% of our base have been active for more than 10 years. Some of those go back to the early 2000s. And finally, we've done a reasonable job of engaging with our resellers around more than one service. So 5,000, those 35,000 resellers acquire a second service through us. With that, I'll turn now to the business, both the core domain business and the value-added services. And I would like to talk to you in the way that I think about and manage the business. And this is going to address the big challenge we've had around communicating what's been going on with our business through the spike of COVID and where we've settled it. So what I have put here to illustrate where we are with the business and what I see. On the left is the gross margin for the first quarter for each of the last 4 years on a deferred basis. On the right is on a cash basis. So if we sell a domain in the quarter for $12, the cost is $9. We have $4 of margin that will flow into our business, approximately $1 of margin over the subsequent 4 quarters. I have managed the business from the beginning to focus on the cash. How much is coming in? How does that compare to the previous year? How much are we spending? What are the economics of the business? So for me, what is happening on the right side is much more important. What is happening on the left is just as it's flowing through over the course of the deferral. The second thing that I've done here is I've split out the expiry aftermarket business and the occasional portfolio sales that we will make within our business. Because that to me is not at the core of the business as I see it, which is the annuity of the domain names, email, and SSL certificates. That's the business that runs and it drives the activity. The aftermarket and portfolio sales will be what they are. We certainly work to maximize that, but they're not the core of the business as I see. And one comment around portfolio sales, it tends to be relatively consistent from year to year, but there will be times when it varies from quarter to quarter. So it can look a little bit lumpy within our business. And when I remove the aftermarket, this is how I see the business. On a cash basis on the right, 2020, 22, and 23, the first quarter, all 3 of those quarters had relatively consistent transactions, and the gross margin on a cash basis is very, very similar. It's up marginally this year from where it was in 2000. And I cannot tell you how much of the business that you see with that spike in 2021 for the first quarter would have happened this year, next year, last year. It certainly did get pulled forward. I can't change that. That's just what happened. But knowing that if I look at the business over the 4 years from 2020 through 2023, that's very much as you have understood the business. Predictable, stable, very, very high quality. That business is not going away. The business drives to a bottom level of profit that is very healthy. and we are comfortable with. So yes, there will be some variation from quarter to quarter, but when I look at it, that time frame, I'm very comfortable that this is as we've described the business, as we've understood it, and we work our way through the cycle of the deferrals from the COVID bump. I want to talk a bit about pricing. As I said, we've managed the business for gross margin. I have to actually work to know revenue on a particular cycle because I can tell you gross margin at a daily, monthly, quarterly level. That's what matters the most. Our management of the business, our incentive structure, what we focused on has always been gross margin. In fact, when I'm asked, well, what happens with a registry increase? Like, what are you going to do? How are you going to manage margins? We simply pass it through to our resellers. Don't even think of the register or the supplier cost as part of our business. It is the margin that we make on each of those transactions that is most important. I have here our standard pricing. So this is a reseller, quantity one volume, what they get in, coming in, no special discounting. In 2000, we priced it at $10. That was revolutionary at the time. And for that reseller, we made $3.75 of margin. We did discount, whether it was to 9, 8, or other pricing. Over 24 years, through countless price iterations, we've managed to fundamentally maintain the same margin at that list price. It's now at $3.85 compared to where it was 24 years ago. Again, it just illustrates the way that we want to manage the business, what is important. And that really does drive a big part of the consistency in our business. I'll take a couple of minutes to talk about how I manage the business, how my team focuses on understanding the health of the business. Many of these metrics are interrelated. And I mentioned that the gross margin on a cash basis this quarter compared to the first quarter of a year ago, relatively consistent. The transactions were basically the same. They were flat year over year. So that's always important for me to understand. Are we driving more transactions, the same number, or fewer? And right now it's at a level state, and that's where it has actually been outside of the bubble from the pandemic for quite some time. Most of those are renewals. It's a great recurring revenue annuity business. Those that don't renew, we are replacing with new transactions. One of the ways we can tell what the number of non-renewed names will be is looking at the renewal rate. We have an incredibly high renewal rate, over 80%. It's been there consistently for quite some time. So our new registrations are replacing the domains that are not being renewed. If that renewal rate goes higher, that will project that the business will be healthier. The third element in this, they're all connected, is the gross margin that we drive per domain year. We do it on a yearly basis, not a transaction basis, because some names are registered for 2 or other increments of a year. So we look at the gross margin per domain year. For our entire business, so retail and wholesale, where we run the back end for other registrars, it's around $2.35 per domain year. Sometimes it's up a little bit or down a little bit. It's been consistent for 5 years. And it's been consistent through the roll-up of acquisitions that we have made. Similar, like quality reseller-oriented registrars, and we've integrated them into the business. And we've managed that gross margin per registration year over that time period so that it is consistent. Any one of these will project where the business is going in the future. The gross margin per domain year is trending lower. If transactions are trending lower, if transactions and renewal rate are trending higher, and the gross margin per domain year is staying flat, all tells us where we are going. So I know that I've got a healthy business here and that these metrics are the right way to be managing the business. And then the last thing, and this goes beyond just domains, this is more business in its entirety. I don't look at expenses relative to revenue. I look at it relative to the gross margin that we drive for the business. This number was into the 50s and 60s years ago. And we've been on a drive to run the business as efficiently as possible. Software and technology and automation are a big part of that. When we acquire a company and we roll them in, this number will go up, as every time we've made an acquisition. And then as we run through the integration and we optimize around how that business fits with what we're doing, we bring this back down. We make another acquisition, it will go up, it goes up, it goes down. I feel like we are at a good level to be spending relative for the business because we're very profitable, but we're profitable in a way that affords us the opportunity and the luxury to continue to reinvest in the business, which drives through technology and automation and software more ways to be efficient, which keeps us competitive in the marketplace, and it becomes a cycle that I feel we can continue to feed upon itself. And the last thing that I look at is margin per employee, and this is on an annualized basis. So we don't have a particularly large team, slightly under 250 employees dedicated within my group. And part of the restructuring in 3 companies 18 months ago was really to allow us to just manage things much better at a business unit level. So I want to see that that number continues to be healthy and is continuing to grow. But all of this tells me that we've got a healthy business. It is not without its challenge, though. And for me, the biggest challenge is finding a way to bring growth back to it. And that's really where we're able to start to shift our focus to now. In 2016, we made an intentional decision to tactically roll up competitors and get scale. We thought would be quite helpful in terms of an advantage within the marketplace. And there was a lot of work. Serially, every 18 months or so to acquire another competitor. And we did it very well. But hard work, there was a lot of work there. We tripled the size of the company. So we went from a relatively mature, profitable business to that same mature, profitable business, but at a much, much higher level. We do have a history of value-added services. And as I did with the story about Van Zugel, I mean, I have countless stories. This is where I could start to talk for hours, and I will not. But, I've got 8 examples here. I'm not going to speak to all of them. At the top is where we've had a good degree of success, and it contributes meaningfully to the business. The bottom, not so much, or it turned out in a different way. So we launched domains as a wholesale service in 2000. Within the year, we had 2 million domains under management. Let's launch a line of SSL certificates. How hard can that be? We had a big plan. 1 year later, we had sold 2,000. It was a fraction of the plan. We partnered with a company out of Ottawa called Entrust, PKI Technology. Wrong partner. We learned they were oriented around government and large account. They did not have the understanding of how you support small businesses, which is who buys through our resellers. So we switched to GeoTrust, and we added a couple other vendors' products. And over years, like a snowball, it slowly built where we put a ton of effort in upfront, limited return, but then we saw it flip one day where we were just spending less and less time, and the business kept building, and it was contributing in meaningful amount to the bottom line. It was great. We're going to do this with lots of services. We tried it with email. We used some technology from a company called Communicate. Hard when you're not in the business, you don't have reference accounts. We, a couple of years later, went out and bought the hosted division of Critical Path. And that gave us great reference accounts. Technology didn't meet our needs. We had to rewrite that, and we did it a couple times thereafter. That business contributing meaningfully now. But again, many years and lots of iteration. The last one is Yummy Names, which was the name for our aftermarket business. We started out monetizing domains through parking pages. Then we realized there was more money in buying them ourselves and reselling them. We built a portfolio of tens of thousands of names. We had salespeople that were trying to sell them. Incredibly complicated. Eventually, we divested that. I think the last of that was the late 2018 or 2019 time period. Now we've got a partner, and we just sell them through that partner on a monthly basis as they're coming out of the expire stream. It's a very nice add-on business for us. So we've had success there. Along the bottom, not so much. 2003, we bought a billing software company. We thought that we could pivot them from ISP billing to hosting. A lot of challenges, sometimes owner-founders joining the company, that does not work, but this business is alive inside of Wavelo today. So Justin still has it, and ironically, it's been successful that way. We tried a blogging tool in 2004. We built that ourselves. We tried white labeling a website builder in 2005. Neither of those worked. Not for lack of trying, just didn't work. We bought a portfolio of surnames, and we were going to sell that email based on the surname through our resellers to their customers. Resellers, they didn't resonate with them. They didn't want it. That's been an incredibly successful business, though, and it's a big part of what Hover is today, our retail domain business. And Ting was conceived of as a wholesale mobile phone offering in the US for our resellers. I feel like I banged my head against the wall for 2 years, and incredibly frustrating for Elliot because couldn't understand, like, this is what the market needs. We were doing it at a retail level, and that turned into an incredibly successful business that before our roll-up of competitors in the domain space, mobile business was starting to get close to the size of the domain business. So in what I would say is true Tucows fashion, a lot of these failures were incredibly successful, but in no way that we ever foresaw. All of this to say, this is hard. It takes time. They don't all work. Some of them do. When they do, if you iterate on them enough and you engage with your resellers enough, some of them work out and they become an important part of your business. So I just want to talk very quickly about a couple things that have happened. And you may not know this, but we had Domain Direct, which was a retail domain business in 1999 that preceded the wholesale business. Learned a lot from that, and we relaunched it as Hover almost 15 years ago now. Rob was a big part of us reinventing that business. We have learned so much over the 24 years about what our resellers need in a domain partner because we run a business ourselves. And this is a retail extension off of the wholesale business and platform. Incredible learning that goes on. We share it with our resellers. We encourage them to copy what we do. We take them through our learnings. It is incredibly helpful to have gone through this experience of operating the business that our resellers are in. And we have had a small hosting company inside of Tucows for about 7 years now. And this is not a business that contributes in a meaningful way, but it's not tiny. It's a couple $1 million of revenue a year. And we have learned through this process what's involved in running a hosting company. And what we've done is taken over assets from our resellers where they wanted to exit the business. So they want to focus more on design and development. We take over their customers. They want to focus on digital services, and they want to find a home for all of their hosting clients. We've taken them over, and it's now afforded us the opportunity where over the last several years, we've run all of the technology that our resellers are doing and all the different variations. And with this in mind, this group of resellers we've focused in on three segments where they are really oriented around this kind of historical hosting. And our thesis is that this hosting is moving to the cloud. It should move to the cloud. We see what it's like to operate servers and infrastructure. We have our own private cloud. We work with public cloud. So our belief is that this is going to the cloud. You shouldn't be managing servers and all the resources associated with them, that there needs to be a whole new tool set around us. And this is really aligned with what we do in our other two businesses, being Ting and Wavelo. This is billing and automation. And this has been our domain platform for a couple of decades. So what we are doing, and we are working away at this, we've identified 10,000 resellers that we think are the best fit for this initially. We're experimenting with some proof of concepts in-house. We look to have an early adopter program in the second half of the year. And I will be doing this entirely within the existing cost structure that I outlined earlier. This will be completely transparent to you in our financials. You won't see it in the gross margin. You won't see it in the OpEx. But we're going to continue to work away at this. And I hope to, in future conversations, share some of the successes that we look forward to having. This is what has Elliot most excited about the business. It's what I'm excited about as well. But with that, I'm happy to answer any questions.
.com domain pricing, how low has it gone over 22 years? Where was the last low price it hit?
So the question was, how low has .com gone, or how low has it been? Are you referring to at a customer purchasing it, the end customer? Is that the question?
Yeah, because you have the $10 and the $13.
Yeah.
So 2023. You correct me if I'm wrong, but over those 2+ decades, has competition sort of pushed prices down a little bit, and then it's recovered. That's sort of the trajectory. What does it look like?
Yeah. So the question is, has the pricing been pushed down because of competitive pressures, market focus? I would say that there is only one direction for the pricing that I've experienced, which is down. Continual pressure on margin. We have managed to find a balance between customers that are willing to pay for the value, and we've done it increasing the volume. So you can find, let me rephrase it. There is a lot of very unprofitable business in our industry. If our cost is at this point $985, I'm sorry, $915 is our cost, $385. Again, that's the list price. So don't think that every reseller pays it. You're managing a million domains, you will pay less. But the cost is $915. I can find places that I can buy for $8, for $2. So there's a tremendous amount of that activity. It tends not to be the kind of customers that we want, and it's not repeatable. So we've found that balance where we have enough customers that are willing to pay something that allows us a decent margin, and they're happy with the service. And it leads to a self-fulfilling. Everybody knows who all of our customers are. It's public, it's well known. And what we hear often is, if it's good enough for them, you're the partner for us. And yeah, I don't need a .com at $8 where I know you're losing money. I'm happy to pay something above cost. I want you to be a healthy, viable partner. But that's not the whole market. That is the portion we participate in. And
more questions.
Got it.
Maybe just online, Dave, very good presentation. You run a great deal of business. In terms of M&A, you have done a great number of deals over the years, Bastio and Nom and others. Can you maybe talk about the M&A landscape, and maybe going back to Elliot's first comments around capital structure? If you do see transactions coming to you in the next year, 2 years? How would you go about funding them? Given in the past returns were great, so we probably would all want to keep doing those. Maybe share some commentary on that.
Yeah, so the question was around potentially doing acquisitions, how we would fund it. I'm going to defer the funding to Elliot because he's the capital allocator.
That's what he was asking you.
But I would say that I am fully aware of all of the companies in the industry that look similar to us. I would tell you that we are very good at understanding. Most of the deals we have closed, from initial conversation to closing has been 120 days. Like, we understand the industry, how to do this, what the key levers are, when to walk away. A lot of the acquisitions that we've made, we've looked at, walked away from multiple times over many, many preceding years. Something that's closely aligned with our business as you see it today. I don't want to diverge wildly from that. I would absolutely do it at the right price, where we felt that the time was right for us as an organization. So it's a combination of, it needs to present itself. I'm not going to go out and aggressively pursue, which would lead to overpaying. We've been very thoughtful in what we will spend. And, it's part of what I look at and think about on an ongoing basis. There are fewer now, I would say, than there were 10 years ago, but that doesn't mean that they've gone away completely. Does that help?
Yeah, and I would say the easiest thing in the world to fund is acquisitions. Lenders love them, bankers love them. The corollary is the hardest thing to fund is buying back stock. So I have no doubt that if Dave can find something juicy, we can get it funded.
I always like seeing what somebody else will pay for it because it's always more than we would have.
Okay, so thanks, everybody. I know we're running a little over time, but we have now Justin Riley, our CEO of Wavelo. Okay.
Does anybody feel the body to intro was an observation that I have to do another?
No. I do too.
I feel like if there's a podium, I gotta use it.
I think that you just want to tower over.
Can everyone hear me okay? Yeah? All right. Yeah, if you don't mind. It's not gonna break the config here. Get all that. Oop. Oh, give away the slides here. I am a small forward in this room between Mark and Andrew.
Every big wanted to be a small forward.
That's all I got left, man. My knees are pretty bad at this point. Okay. I was trying to think about the right metaphor to open up today. And since we're post lunch, I think I'll go with this. For the people that I road tested this on in Omaha, you still have to laugh. If you're in this stock today, you are either buying domains and getting Ting for free or buying Ting and getting domains for free. And so if that's the lunch and the dessert, I'm that like bread with the olive oil that you get at the beginning. You're not sure if you want it. It depends on if it's what kind of diet you're in at the time. So I know my place. I'm here at the end. I'm going to try to be brief, but I did want to open with a couple kind of important things that I know a few of you have been following Wavelo closely are worried about and thinking about. The first thing is the amount of dollars needed to get Wavelo to a point where we're generating cash. That's $0, so we'll do that this year in 2023. We've heard all of your feedback into Elliot, into me, as well as into me directly for the few of us that have met. We can't invest in two growth businesses at once, so we won't. So most important point is we don't expect to need to put any more capital from TCX down into Wavelo. We'll generate cash now. I won't tell you how fast I'm going to grow. That's always challenging. There's a trade-off between measured growth and profitability and growth at all costs. But we'll go in one direction and it'll be, for all intents and purposes, free for you going forward. The second thing is, as we get on the other side of migrations, I'll talk about where we are with those in a bit. We'll generate $25 million in revenue this year, north of $25 million. We expect that to continue to, follow suit as we migrate customers. The third thing is, 2 to 4 million in adjusted EBITDA with positive cash flow. For the last 5 to 8 years in software, there has been a wild disconnect, particularly in the public and private markets, awarding growth at all costs, sometimes 100 times NTM revenue, which is about as absurd as I've ever seen. And now there's a flight to quality in the market. Luckily, we are building this business inside of Two Cows and have thought about efficiency. I view this as a beautiful constraint to be building a software business here, and remind my management team of that very, very often as we think about spend versus growth and efficiency. So 3 big things up front: $0 of new investment, 25 million in revenue, and 2 to 4 million in adjusted EBITDA with positive cash flow. So I'm going to raise up for a second and talk about why Wavelo, why now, what's going on in telecom, and why would we build this business today. The first thing is 5G is growing up. It's going from being an adolescent to an adult, 1 billion humans on 5G globally, and yet heading towards 3.3 billion in 2026. So kind of a ramp there as this continues to be pervasive throughout the world. The problem is that operators aren't seeing their return on their investment. European telecom CEO got on stage at Mobile World this year and said there is no business case for 6G. Full stop. And a lot of it has to do with what Ellie was talking about with the unlimited price coming, if you were to normalize for currency and region, below $40, right? And so if you kind of narrow in on that $10, $25 range, it's hard to recoup your investment over time. The problem is only getting worse. And then if you look at traffic to revenue forecasts towards 2027, traffic growth up 200%, revenue only up 14%, ARPU declining by 7.5%. We would posit at Wavelo that one of the reasons for this is that no one has built software for now and for the futures. We are all still using software from copper and 3G in previous eras, and there is a way to get value out of the network that hasn't yet been realized, and it's one of the big reasons why we're building Wavelo. We think it acts as a tailwind for us. The second thing is, and for some of us that have taken walks in parks and talked about private networks, you know me to be a private 5G skeptic. I've watched lots of operators build products to monetize excess network capacity and not have product market fit. The 2 big problems with private networks right now are, one, the customer has no idea how to buy it. They aren't sure if it's a managed service or whether somebody else is going to manage it for them, or whether their IT team needs to pick it up. The second thing is most of the networks and software providers aren't able to actually deliver the value prop of what the promise of private networks are. So something like being able to bill and provision for the 6 hours a ship is in a harbor, that doesn't really exist today unless you go with a modern platform that kind of treats billing provisioning as truly modular. So we think, there's lots of speculation, there's lots of hype. Verizon and AT&T backed off in their latest earnings remarks. Dish is still full steam ahead because they're building a brand new network and they believe it's purpose built for stuff like this. And we think when you couple that with great software, we can kind of help in this arena in the future. If you take nothing away from my opening remarks here, please take this slide away. Elliot, as sometimes he does, gives away a slide earlier in the presentation, but cloud transformation in telecom, particularly in the OSS BSS space, is sub 10%, around 5%. This is a great graph from Houlihan Lokey. It shows that CSPs globally are going to invest $1 billion in cloud transformation over the next 3 to 5 years. To put that into perspective, that's 38 to 44% of their cloud transformation, but their network transformation budgets. Just to be cloud with all of the other capital that would go into the network is tremendous. This is, the time is now for this cloud transformation. It's becoming a burning platform, and it's the reason why switching, which has been really, really hard for 15 years, is now going to get easier in the coming 5 years. If you were on an incumbent on-prem platform today, moving from that platform to a cloud version with 1/16 of the features is just as hard, if not harder, than moving to Wavelo. And so we think this moment, which has been really hard and would have been really hard to launch this business 10 years ago, is changing and will change over the next 5 years. There's a bit of comments around fixed wireless. So we're seeing, some fixed wireless traction. Verizon had the best quarter they've had in their broadband group in a decade. That they kind of bundle Fios and fixed wireless together. But if you unpack that, 90% of the net adds will be fixed wireless. Now, 70% of those net adds were bundled with a smartphone. So TBD on whether this is subsidized growth or not. But T-Mobile and other players are seeing some fixed wireless traction. But I agree with Elliot's frame about the kind of percentages of how the markets are going to shape up. T-Mobile has said publicly they'd be great, super happy if a total of 7 million fixed wireless subs were kind of where they stopped. But what's important for Wavelo here, and what's important for all of you, is that you get to place both of those bets at once, right? So if Wavelo does business with a fixed wireless provider, you get kind of a piece of that action as well, right? And so we think that as more human beings are connected, that the ways in which telecoms connect those folks need to be modular, need to be flexible. Today, if you have a kind of one telecom business and you launch a new one, so you're going from cable to fixed wireless, or from mobile to fixed wireless, or fiber to fixed wireless, you are essentially bringing on a whole nother set of systems and a whole nother team. It's tremendously inefficient. So we think that billing and provisioning across all of these network types, all of these customer types, is the key to getting to a platform that's flexible enough for the future for telecom. To build on that point, cable cos are launching mobile. You heard Elliot talk about it a few times. We're seeing Xfinity Mobile have back-to-back record quarters and still only penetrating about 10% of their cable base. If you go and pick any of these providers, when they've launched mobile, they're launching it on an entirely different platform than their fixed platform, with a mobile team and a bunch of other systems, and at some point has to come back to a head. For any of you that have tried some of these products, you'll notice that when you go to have billing interactions, it feels like a different company, even though it says the kind of brand logo on your bill. And oftentimes you have telecom executives winning one bill initiatives for redesigning the bill to try to make it look like it's the same thing. But at some point, as an industry, we have to solve this problem. It's inevitable that we have to solve it. And so this is internally, I say, why not us, and how we're thinking about Wavelo for the future. I tried to figure out what was the most PC word to put on here, so I chose abysmal. Customer satisfaction in this particular part of telecom, so operators buying OSS BSS software, is abysmal. This is a quote from one of the global telecom CTOs who I love and find to be one of the smartest people in the industry. And I asked him in Barcelona this year, why a couple of years ago did you go with the one of the incumbent providers? Like, you know better. Why would you do this? And he said, and I quote, because there was nothing else, and we started trying to get off of it before the ink was even dry on the contract. And I told the SVP of sales that to his face. Right? I'm spinning up a Tiger team to get off of your stuff because I'm stuck with it. That is the level of customer dissatisfaction in this space. And to dovetail on some of the pieces, we just have to be customer aligned and care about our customers to win in this going forward. You've heard a couple different folks, Dave, Elliot, say everything is just billing and provisioning. We believe that to be true. It's one of the reasons why Wavelo makes sense in the Two Cows family, and we have to just be phenomenal at making that statement true. This is the only beyond 2023 statement I will make today, and I won't come back to it for a couple of years. There's a lot of hype around generative AI and large language models. I was fortunate enough to be working on some of this stuff before it was cool, pre-crypto revolution. And one of the things that's true when I talk to AI leaders trying to bring this technology into telecom is they have two really big pain points. The first is they can automate and augment the conversations out the wazoo. There's no problem with that. The tech's good enough. But the minute they need to take action and change a customer's bill, give them a discount, give them a new product, they have to hit a billing system from 25 years ago. And it breaks. And that's why you have that moment that we've all had with chatbots where it hands off to a human and they're swiveling between different panes of glass. That's because the billing system can't answer the call from the language model. So fundamentally building better software for that solves that problem. Full stop, just cloud native event-driven software, that problem goes away. The second long-term problem, which is one that will plague healthcare and telecom and government, which are the three industries that typically get this new tech last and have the biggest, have hardest time getting value out of it, is getting the data out of a system of record. And one of the things that's beautiful about building Wavelo as an event-driven system is it acts as a heartbeat. It's just constantly pulsing and emitting events of how the telecoms operate. It's John paid his bill, John's moving, John needs a new SIM. It's constantly happening. So in the future, one of the things we'll be able to do is put a large language model on top of an event-driven system and build a continuous learning loop that doesn't take all the manual effort to get the data out of the system of record. That sounds really complex and esoteric right now, but it's kind of the key to unlock the value in telecom. We're not even pricing this in today into what we're selling. We think this is an Easter egg for our customers 3-4 years from now as this comes into the market. So quick summary of this section: headwinds, tailwinds. On the headwind side, our biggest headwind is kind of any software company's headwind right now. The macro, broader macroeconomic environment. The biggest piece is we're hearing folks say, listen, we love you guys. This is great. We want to keep going through the biz dev cycles, but I just want to give you the heads up. We've got, kind of more procurement scrutiny than we've ever had, particularly on software as a service purchases. So it might take an extra quarter or two, but we want to keep going. So we're not seeing interest wane, but we are getting the heads up that procurement is gonna, make them jump through a little bit more hoops, which means we're jumping with them. So that's the biggest headwind. On the tailwind side, to summarize the last couple slides, cloud is turning this into a burning platform. The second is network ROI. There is a kind of renewed obsession out of getting value out of your network. The third is competition is picking up and you need partners that are going to help you compete in a different way. And the fourth is there's going to be more switching in telecom than in the last decade with the economy. And so, telecom operators are going to trade customers and need to be able to get marketing offers and be nimble in the market much faster. So we think, and I'll wrap this part of the presentation up here and talk more about how we're performing right now, but we think this model for OSS BSS, software as a service, subscriber economics, is fundamentally better. For those that aren't close to this space, the way a typical OSS BSS interaction would have worked over the last 20 years is Lorenz runs a telecom and I say, what do you want? And he gives me a laundry list of stuff and then I build to those specs. And then now I'm the only mechanic that can fix the car and I line up a list, a big long line of professional services behind me, bless you. And then I just kind of milk the account for professional services revenue. There's lots of reasons why that's wrong. I don't have a lot of time today to explain why that's wrong, but we think being customer aligned, being SaaS focused, when a customer wins, we win, is more efficient, it's better customer experience, it's reliable and repeatable over time. Before I go into today, any questions on kind of the setup, why Wavelo, why now?
Justin?
Yep.
So is this an application layer OSS BSS platform?
Sorry.
Would this be similar to something like Matrix?
Sure.
Okay. Okay. So could you maybe compare and contrast how you're performing relative to Matrix? Because they've had some good wins with incumbents.
Yeah, I mean, I wouldn't pick on Matrix or Amdocs or Netcracker or any of them and say, how we're doing selling against them. But what I would say is, most of that software in that category is, as I've described, pretty old, pretty modded for this era. And where we're finding traction in the market is folks that want to do something new. And I'm going to talk through in a couple slides some of the BD effort that's going on and how those prospects are finding value in Wavelo.
And could you just reiterate again what you were commenting about the private 5G market?
Mm-hmm.
Do you see that just as a little hiccup or whether that's the real
I think what has to happen is, and this is one of the reasons why we say billing and provisioning for every interaction in telecom, what has to happen is billing and provisioning software has to be so good that it doesn't care whether it's a ship import, a handset, OLT on-prem. It's a unit that needs service. It needs to be billed for that service. The problem is a lot of what's in the market that has been kind of modded for private 5G or private networks doesn't actually act that way. So what you're doing is you're taking minutes or usage-based billing and kind of hacking it together and then changing the line item on a bill to be the ship and harbor. And when people are trying that out, it's more expensive. It actually isn't, it actually doesn't work for their use cases. And the problem with those private network contracts is they're 10, 20, 30-year contracts, right? So if you don't get it, anytime there's some kind of murmuring in the industry about it not working, everyone backs off. And that's what you saw in a lot of the big telecom results in Q1 was people just kind of going like, wait, we got to wait until this gets better before we start buying.
Yep. I think it was the foundation of Wavelo. So assets were basically, I guess, vended from these or transferred from these group into that. How much have you repurposed existing stuff they've had? How much of it is new or
yeah.
maybe recoded or
Yeah, so we've done a lot of work. There's a big foundation, not only in kind of the billing piece, but also the pieces that have underpinned Ting Mobile and Ting Fiber. And one of the beautiful things about that is, often software businesses are, science projects. They're not shooting, they're not working with customers, and they're not, kind of building on exactly what customers need. So we went into this business with a deep understanding of telecom, and so there were core pieces there. And then we've done a lot of building in the last couple of years to build the event-driven pieces of the platform, and that is ongoing as we work with Dish, as we work with Ting. That continues to kind of drive our product development versus the mad scientists in the beanbag chairs, not building things that matter for customers. Yeah. Okay, for the interest of time, I'll keep rocking. So quick view on first quarter earnings and then quarter over quarter, year over year. So 7.3 million in revenue, up quarter over quarter, and year over year. Gross margin following suit, and then adjusted EBITDA up quarter over quarter, but down year over year. Largely driven, as I said in the earnings remarks, 2 non-cash items: the Dish contract unwinding and lower labor capitalization rate. The most important thing about Q1 is understanding that we are nearly done. We are expected to be done middle of the year with the Dish wireless boost migration, and that's really what drives revenue growth. So what you have here is Q1 22 through Q1 23, and then you've got kind of total subscribers under management and the subscriber growth rate quarter over quarter. You see up until Q3 of 22, we had under right at 1 million or under 1 million subscribers. You see that double in Q4 of 22 to 2 million subscribers. You see that more than double again in Q1 of 23 with 4.2 million subscribers. And then as we sit here today, even after closing the quarter, we're north of 6 million subscribers. So you're seeing this ramp really, really fast. This migration took a while to get going. We were doing lots of work for Dish, lots of one-time work to get them up and running. But once it got going, you're seeing this just rapid pace. We're migrating hundreds of thousands of subscribers a week and sometimes in a single evening. This is the fastest telecom migration I've seen in my entire career. And it's built the muscle for future, because the two most important things are network integrations and customer migrations in this business. So we got to be great at both of those things. And we expect this to continue to ramp and be kind of wrapped here at the middle of the year. My slide earlier about we think this is a better business being customer aligned, being kind of focused on per subscriber economics and a more traditional SaaS model. Wanted to give you kind of a view of Q1 revenue composition. So in purple, we've got platform revenues. That's the recurring sticky revenue that a couple folks in the back were excited about. And the second thing is in pink, the professional services revenue. We don't expect a world where we will have kind of zero professional services revenue in a year, but we do want a composition like this. And if you were to look at some of the incumbents, you would see a completely different revenue mix composition. You would see 3 times professional services revenue to licensing revenue. And even inside the licensing revenue, that's a licensing model from the 90s that also kind of acts as a wedge for more professional services. The 2 places where you might see us take on professional services revenue are in the beginning of a contract, where we start to do some early integrations, and then later, 4 or 5, 6 years later, where their business is changing and they're asking for a bit of work to kind of keep up with their business. So expect that to kind of ebb and flow, but we want that to be around this mix going forward. The next 2 slides are a bit accounting, but I wanted to unpack them a little bit. Ellie and I joked before about me doing accounting slides. So this is GAAP revenue and the contract asset unwinding. So you've got Q1 22 through Q4 of 23. So to unpack this a little bit, in yellow, you've got the contract asset. In pink, you've got professional services, and in purple, you've got platform revenues. So the way these contracts act is they kind of act over the life of the period of the term of the contract. And in the early years, the contract asset acts as a kind of accretive to revenue, positive to revenue, or later, my favorite term in all of accounting, contra revenue, in the later years. And so you kind of see that, Q1 helping with the GAAP revenue as you get down to kind of Q4 22 and into 23, you see that acting as contra revenue. So this is a bit muddy in the results year over year, but the important piece is if you focus on Q4 of 22 and Q1 of 23, the purple kind of graph, and you see that grow proportionally, the toggle back and forth there, proportionally with subscribers going up. This, as we've said in the remarks a few times, this will kind of continue to unwind as the contract comes up for renewal in Q3 of 24. And I believe, Dave, it's 5.3 million left to unwind. So 5.3 million left to unwind, and we saw 2.2 million of that kind of unwind in Q1 of this year. All right, so last accounting stuff. You asked about, you asked about the work that's been done on the platform, and what you have in here in the middle is, some of the capabilities and services that we have. I won't spend time on that today. Go to the website, wayflow.com, plug for our marketing folks. Check it out if you have questions. I'm happy to answer it. But the team has made tremendous progress on these features. And when we do that, we capitalize labor. We shared that we capitalized 16 million in labor in 2022. As the team shifts to bug fixes, migrating subscribers, ramping up on new projects, we'll capitalize less labor. We look at this as, kind of a function of the work. And as Elliot will often say, take your pain up front. We do that at Two Cows. We want to capitalize what the accountants kind of make us capitalize. But as, kind of guidance for 22 or for 23, we'll capitalize 40 to 50% less labor in 23 than we did in 22 as that work shifts. Now, all of that goes in and kind of creates these wonderful products and services that we have, and then helps us grow revenue per FTE. I love that Dave put his margin per FTE in the slide when he knew I was going to show revenue per FTE, but we'll catch up at some point. So 140,000 roughly revenue per FTE in Q1. We expect this to ramp up as as the migrations finish and you start to get a full quarter view of the business after migrations are done. And we expect that to kind of ramp up in range of software companies north of 20 million ARR. So we think that will look better as we're done with migrations. All right, I'm going to talk a little bit about pipeline and then I'll wrap. I'm not going to reveal any new logos here today, so everyone take a deep breath. But I do want to talk a bit about the types of personas that we're talking to and the types of customers. So the first is Prospect A, an ISP, mid-size, rapidly growing, operating in 14 US states. Think about them. Is that me? Too close? No? Okay. I'm just getting the feedback here. Operating in 14 US states. Think about this similar to Ting. They have grown through acquisition and they've got three big problems. The first is they've got billing systems all over the United States and they need to consolidate them. And they're looking at kind of ways to do that and really struggling to find a provider that can help them do that as fast as they want to move. The second thing is they want to make more acquisitions and they want to have a billing and provisioning system that helps them as a feature of their acquisitions. And the third thing is they want to launch things like mobile and fixed wireless, and they don't want to kind of buy another system to do that. So encouraging conversations here, and excited to keep talking with them. The third thing is, or the second thing here is ISP plus mobile. This is more greenfield than kind of Prospect A, working in West Virginia. We love their mission, focusing on underserved communities. Step back because it's definitely in my ear.
I can hear it.
Yeah, there we go.
Good. What's interesting about this being more greenfield is out of the gate, and I think we're going to see this from lots of folks that are launching today versus having launched for the last decade, is they want to be purpose-built to launch fixed wireless, mobile, and fiber all at the same time. So when they're looking at doing that, they're looking at buying a myriad or a smorgasbord of systems. And that's just, it's just cost prohibitive for them given how much capital they want to put into the ground. And so they're excited to talk to us to be nimble for the future and kind of future-proof their business from day one. The third is a tier 2 US wireless provider serving millions of customers across the US. They have built an amazing, amazing business, but they've done it by building their own software, and it is now hitting a point where they have too many folks on the platform, and they, one, can't scale their B2C business, but more importantly to them, because they think they're generally at the kind of market share they're going to get to on B2C, they're really struggling to launch B2B and IoT. And so they want a provider to come in, help them with B2B and IoT, and then slowly eat the B2C platform over time, so that at the end of it, they get to kind of a platform that builds and provisions across all of these customer types. And like lots of the prospects we talk to, it's about getting marketing offers into the market as fast as possible. Later in the year, we don't have it today, but we're going to put out a couple customer case studies. And one of the things you'll see in there is just A/B tested against some of the legacy systems in market, how fast we're getting offers and SKUs to market. Certainly, it would be better in telecom if folks acted like Ting, but I don't have the liberty of just having Ting as my customer. I have to work with everyone. And so we know there's going to be lots of SKU bloat and lots of new offers coming in, and we got to be really great at getting that to market in hours, not months. Last slide. Wanted to break this down a bit in kind of opportunities by need and opportunities by segment. So on the left-hand side, this breaks it kind of in these general categories for OSS, BSS, orchestrate, provisioning, and billing, where you see the Wavelo logo. The marketing team agonized over how to put this graph together, so please like this graph, and I'll let them know that they did a great job. The concentration is really, kind of billing and provisioning, a bit of orchestration, but not as much on straightaway provisioning or straightaway orchestration. When we build this business, I've had this problem in starting software businesses before. You can get out over your skis trying to be everything to everyone. And we want to be really focused on what we're great at and say no to opportunities that we're not, that don't fit what we're building and what we think is most important for the future. So that's the concentration. Expect us to, kind of do business with folks that need those things. And then on this side, you've got B2B and consumer on the bottom axis and ISP and mobile. This kind of shows you the concentration of the conversations we're having now, a bit of ISP, fixed wireless, add some mobile. And then on the mobile side, we're seeing B2B with, kind of B2C following later in the relationship. So since we're short on time, I could rant for a while, but I'm going to pause there and see if there are any questions.
I just had a question on, is the likely future use of generative AI, is it insurance against SaaS fatigue?
Sorry, insurance? Did you say insurance?
Is there an insurance against SaaS fatigue?
Tell me more about SaaS fatigue.
Well, because in previous, Amdocs or whatever, you ship a system that's in-house custom built on a client side. Client-side server or something.
Yeah.
With everyone moving to SaaS and everyone kind of looking at macro and saying, hey, I've got my subscriptions, or do I really need this?
Yeah.
Will the application of generative AI and the ability to say, customer just migrated on October 24th, I need to, figure it out. Like, is that going to be an insurance for that?
Yeah, I think it's a great question. And the first, the real answer is we'll see, right? We'll see. We're going to see over the next 4 or 5 quarters what SaaS fatigue in this market looks like now, right? Because we're going to see people, and we're already seeing people cut SaaS budgets for things they don't need. It's mostly in kind of zero interest rate policy purchases that maybe were nice to have but aren't core to the business. I like a boringness as a moat business, which is underlying plumbing. I think we're going to be critical to business operations, and so I think from our standpoint, we're not as worried about it. But I think on the generative AI piece, we're going to see compute certainly go up. We're going to see systems of record that are core to getting information into those models, that usage go up. And those are the places that we'll see it go up. You might see certain other channels turn down. So an example of that might be, maybe you aren't paying as much on SEO or search as you were before, because now you're shifting your dollars to, a specific channel touch point that is answering my questions in kind of a more modern way. But we'll see on, I don't have a crystal ball on SaaS fatigue, but that's generally how I would articulate.
Just on customers, I get like 3 prospects. I'm kind of curious into those discussions. Do you think you can share them? Are people waiting for you to get, this finally fully onboarded for you to be comfortable to take more on? Is it discussions on pricing, or where you stand on pricing? And
yeah,
you can sort of pacing customer onboarding you think you can do one at a time? I mean, what's the bandwidth on your team once Dish is behind to start onboarding and I guess starting to show meaningful growth on top of Dish going forward?
Yeah, the best way to explain it is I'm seeing sales cycles act as telecom sales cycles, which are long. I'm seeing them a little bit longer because of this new, I mean, there are real, like, do not spend on SaaS this quarter conversations going on inside of a lot of companies today. But you can turn your budget back on next quarter. Like, that's the type of stuff we're seeing. So we're not seeing kind of a slowdown in interest, but we are seeing kind of traditional telecom sales cycles elongate. I haven't heard a lot from folks that they're worried about where we are with Dish. I think they're excited. That's normally net positive because typically when you're a software provider of our age, the question is, can you scale? And we've got a really good answer to that question, and that's worked nicely. The other thing is references really matter, and to have a large mobile provider and a fiber company like Ting as your kind of anchor customers for references really helps in those conversations. You don't have to go through as many hoops, and it seems like the demos don't need to be 60 minutes. They can be 20 minutes, and we get on to the how does this actually fit for the future.
And just onboarding, you onboard prospect A and B at the same time, or we
Yeah.
try to split them over time?
Yeah, I mean, look, if we landed Vodafone tomorrow, that would be a big lift to get up. But if I landed Vodafone tomorrow, I think you guys would be okay with me just hanging on with Vodafone for a bit. But as you go down market, we can handle lots of folks. And if you get kind of further down market to some of the prospects, the smaller greenfield ones, we can do lots of those at the same time. It's turnkey SaaS at that point. And I won't spend a lot of time on the different modularity, but the way we've built the platform is you can take pieces of the platform. You don't have to kind of buy the whole thing at once. And we think for switching and for BD conversations, that makes it a lot easier to start to do business with Wave.
Elliot has a question.
Oh, wait, are you acting as Elliot at TCX or as my client?
You showed your 3 projects. That was great. They all have to be in the US. Are you also seeking people to?
Yeah, so again, a lot of anxiety from the marketing team about which prospects to pick for this deck. Yes, we have lots of global conversations going on. I think those 3 best exemplify the needs of the customers we're talking to. And so I would apply that to the global opportunities as well.
So I had someone tell me that OSS BSS systems don't travel globally. Would you disagree with that, Matt?
Say it again?
I had someone tell me that OSS BSS systems don't travel well across geography.
Yeah, I would disagree with that. I think up until this point in time, that is true. Largely, that's been because the network integrations take a really long time. Our approach to software, we did, the AT&T integration in 8 weeks. When I've seen that done before, 9 months, 10 months elsewhere. So we think we have to be really good at that. Then now it's execution, right? We got to show up every day and be great at that, but we know that's important. The other thing is typically the ability to operate and sell these things has been really challenging globally. We're going to take a slightly different distribution approach to that, and I'll talk about that, in a couple quarters from now. But I think that's a way to solve that.
And Thanos, there's another bit there. Historically, as I've heard what you've described, that connects to payments. And payments themselves have been historically very vertical national businesses. 2 things. Here you really can just, integrate different payment blades and get away from that. 2, there really has been a globalization of payments, particularly compared to, kind of 2 and 3 and 5 years ago. So a lot of that, we would see that in the domains business and hosting, billing, and provisioning, where it would really be very national and regional, and that started to change over the last while.
Okay. Thank you, Justin.
Thanks, everyone.
And lastly, for our close briefly, and I know we're long on time, Michael Standing, CEO at TCX, just a little bit of the whole company. COO.
We didn't replace you yet.
No.
I feel like I feel like if you wanted to sort of compare and contrast Justin's height to my height, putting me directly after him is a good way to do that, aside from just being right next to him. Bear with me 1 second here as I get my notes. As Elliot said, and Monica said, I'm COO here. My main focus is on leading our suite of shared services to provide the back office functions that our 3 operating businesses need in order to cruise. We've organized these into 2 main functions. The first, no shock, this is your GNA, and that's going to be the usual cast of characters in terms of people, which is our HR team, finance, and legal. The second are our technical services. This includes our infrastructure team, our information security, our IT, and our data science and enablement teams. Our shared services are a profit center for TCX. We operate at a cost plus 10% model. In a similar situation, 15% would be a fair price, 20%, as Elliot likes to say, would be a get off our platform price. While we do bring efficiencies through economies of scale, if any of our businesses feel that they can do something more efficiently and effectively, we do encourage them to take it in-house. To date, that has not happened. If for whatever reason, one of our operating businesses were to ever leave the Two Cows family, we would be able to maintain the same operating framework for the external business if it makes sense. It's not something that we would offer generally, but if that were ever the case. Over the last 5 years, Two Cows has, of course, grown into 3 very different businesses, and we have completely changed our corporate structure to lean into our operating businesses. There are so many intricate business processes that are embedded in that. For example, we've grown our information security practice to complement 3 very different growing businesses, which has also increased our attack surface. InfoSec is a rapidly changing space, and it's a race against threat actors. Well, I'm not going to pull back the entire curtain. I will give you just a little peek as to what goes into it. The first is going to be around protecting our infrastructure and our network perimeter. The second, having an effective threat intelligence and vulnerability management program. Third, responding to threats and incidents as they come up. The fourth is to continuously train everyone in the business to be able to practice best standards for security hygiene and not open phishing emails. And the last is to continually hunt for vulnerabilities, identify them, fix them before they become a problem, and remediate that. This is just scratching the surface of what our information security department does. When we efficiently manage our security operations or efficiently deploy new infrastructure, onboard new employees, count the beans, when these things are done effectively, it allows our operating businesses to lean into what they do best, which is engineering, product, and sales, which are the true success differentiators. Prior to my move into the COO role, no one was in the seat. Elliot likes to refer to me as a referee who has stepped in to get everyone to play nice together. These things were being done off at the sides of people's desks. And one of the themes that you've heard throughout the entire day today is really around efficiency. And I have probably said that word 10 or 15 times just to nail you all over the head with it. We're structured differently today to be able to deliver for our 3 operating businesses. And we've built an exceptional team that is in a position to excel over the coming years. If I'm doing my job, you're not going to see me except for on Investor Day. And so that's what we're going for. So thank you.
Thank you. That was successful. So you can just move. I think I just threw one in there. Yeah. Yeah, that's great. So thank you. I know that that's a long day. Kind of feeling good that we're only 35 minutes over. You know, it was pretty tough to estimate around 5, 6, 7 different pieces. You know, I think the place I want to close is to pop back to where I began. You know, I came into the day today believing what I told you at the beginning. This business is thinking for the long term. This business is leaning into management excellence. This business is all about creating value in every opportunity. You know, for me, I got to watch this all day, as did all of you. I feel better about all of those things than I did coming in, and most of it is what I know. You know, I think that, you know, I've said, I have, in the last 3 months, I have spoken to shareholders more. I have checked the stock price more than I have at any time in the last 20 years. You know, even when we spent years in the desert, there were no expectations. There was no pressure. There was no downside. It has been it has been clear to me. I have been made, not been made deeply aware, I am deeply aware of how, and here when I say for all of you, I'm talking about, you know, the 12, 15, 18 owners of the business, you know, that are here. I know how the last 6 quarters have been for all of you. I want to make sure that everybody in this room knows that I know that. I think that for me, throughout all of that, I mean, there's really never been a day when I was worried existentially. I did deeply experience all of your worry. I experienced all of your support. I experienced all of your interest. And when I say good wishes, you know, that sounds trite, but your real efforts to, you know, see us understood for what we are. You know, if there was anything that challenged my faith, if there was anything that made me deeply appreciate how hard this would be for all of you, it was seeing when you would have done it. Never once did I, you know, think negatively of that, but boy, did it make me appreciate, you know, how hard your jobs could be sometimes. You know, I say what I say next and last, you know, meaningfully. When I said at the beginning, you know, this is a small group of owners sitting around the table. This is a strange and wonderful cap table. I want you all to take that as opportunity. I want you all to take that as an invitation to bring yourself to this investment differently than you need to for most of your other investments. You know, I could pull up that cap table again. Almost all of the stock are people that when I say I know, I feel like I know you all who are holding real stock in the room. You know, some of you I'm just meeting more newly, but you all know each other. It was amazing to me to watch all of the cross-shareholder communication. You all worried about each other. Look, that means that we together have the opportunity to do things a little bit differently if we can hold it all a little bit differently. This
has been a unique and tough time. I say unique. The coax to fiber transition, that's a once in 3 or 4 generations transition. The amount of capital that requires relative to a business our size, that's never going to happen again. Certainly ain't happening again in my lifetime, I promise you. And I really, I think there's very few places. Everything I've done, everything we've done has been in the context of deep roots in the internet. Capital non-intensive businesses. The only thing I can think about that would be, or that label could apply to, that would be capital intensive. And it's behind us. That syndication is in place. We're going to round things out. This is the trough of just about every negative number that you'll see, speaking generally. So, and I think that what I again want you all to hear out of that is appreciation for each of you. I want you all to appreciate each other as well, and know that and I hope you come out like I do, just sort of seeing all of these amazing things that the roots are deep on. So I can close it. You got a question from the floor?
I have a comment that I'd like to share.
Sure.
From Colin.
Yep.
Coming back to the Dutch-anality, the ship has left the port and we're waiting for the ship to come back full of gold and spices.
Love this. Yes, stretch a metaphor too far. No, but I love that. Thanks, Colin. So if any, I didn't want to, that kind of feels conclusive. It feels almost like I precluded any questions. I know some of you are on the 615 and you're on 615. 620. But if anybody else has any more questions, and we're going to hang out a bit, but do ask your questions with everyone. Don't just kind of wait and then, crowd around people at the end.
I mean, the business is still there's still 5 years of building and probably 8-9 years until steady state or whatever.
You do start to see, though, the EBITDA trough turn.
Yeah.
And it does start to, if we're lucky enough to be able to build, based on what you're seeing there, you're going to start to see the EBITDA be positive, 27, 89.
Yeah.
Okay.
But I mean, it will be some more difficulties of building in the public eye.
Sure.
So, what ways do you see to address this?
Yeah, so there's a couple things there. I mean, really 2 primarily. One is we don't, look, it's there. Most of the time, I think it's easier to be outside than inside. This is one of those times when, from a worry perspective, it was a lot easier to be inside than outside. And so, and I hope you've heard me call that out. But the funding is dealt with, right? The hardest part of this is done. It is, when you saw that phrase, maybe bankruptcy remote. You've heard me talk about the firewall of these businesses. So what goes on in that bucket is going to go on in that bucket. We all just have to watch that we're hitting those targets. I think they're very clear. So I think, the kind of point 1, that the hardest work is behind us. The business is scaled. The evergreen funding mechanism is in place. 2, I hope and think that we get a little better every quarter at explaining it. Every quarter that we kind of, we come into a new set of questions leads to new and better disclosure. And I just think we're getting a little better at that. I think it is still far from perfect. Just got to keep working on it. But I think that, so it's less pressure on the thing being shown, and then more explanation.
Yeah, it's hard to figure out what is the market not like, right? Is it the fact there's 3 different businesses? Is it the leverage?
I'm going to get you back in here, right? I'm going to get you back in here. When you say what the market was like, this company is owned by the people in this room.
Full stop. That's what I think. There's not some other people out there who are selling, because I know where the stock is. We can go through the cap table.
Yeah, there's a capacity as to how much my firm can absorb or others.
Totally.
At the end of the day, that's the issue.
I don't want, I want to separate what I just said from, because what I did, what I wasn't addressing there, and I should, is do we need to do a better job? So one of my big takeaways from this time period is if I'm going to be on the bench this long, I better get off my ass for stock. So, you know, which you know, you and I have been talking a long, long time. You know, I hate to do. I love having deep discussions with folks in this group. Those are smart, they're business folks. You guys all challenge me. It's, you know, it's a good deal. And I hate page flipping for somebody who, you know, it's like, oh, so what do you do? And so that's my problem, and I can't make it yours. And so I have a deeper appreciation of that. I think that, you know, what you're seeing, you see Monica now get this role that helps. You know, part of what she's doing is outbound. You know, are we going to be doing a bunch of investor conferences? No. But are we starting to target, you know, a couple of you know that I've said to you, hey, you know, who are some other, you know, who's another investor or two that you think might be appropriate for this? That's, so again, to the, okay, we're a public company, but it's a little bit different. We're going to go approach that a little bit different. So, I know I have failed you on that. Is that it? Thanks. More questions?
We did have one more question online. It's relating to Wavelo. If you would like to get into that.
Sure. Where's Justin?
Okay, it's from Alex Fortune, and he's asking, he's trying to triangulate where the Wavelo revenue per sub and the Dish sub base will be once the Dish ramp is complete.
Oh, yeah. I mean, we're always loath to talk about Dish's numbers. What I would say is that stuff's probably still not gonna, it's not gonna get you to the place where you'll be able to calculate a per sub number, probably for another 5 quarters anyway. That is a hand, not a stretch.
I'm relaying an investor question.
Oh, lovely.
Which is the accounting around the ABS. So do you just recognize the full revenue amount and then pay them, or just some amount of revenue not get recognized? You recognize the full amount?
I see. When it's coming in. No, we've recognized all of that.
Yeah.
Yeah. The maintenance cost, you want to think about it almost as a, you know, we have to operate as a servicer of the asset, right? So there's this separate structure where we're a servicer of the asset, and you collect all the revenue on behalf of the syndication, and then you have this small amount that you can deploy, and then you pay the debt holders their coupon. Then it goes back to the, you know, so think of Ting the servicer, and then it goes back to Ting the operator.
So there'll be some accounting on the maintenance cost separate.
No. Yeah, I was going to say no. I mean, it's the way the cash flows doesn't touch the accounting. Yeah.
Yeah. So, I have a quick question on the ABS facility. So I saw you got, I think you paid down like
31.
Yeah, that's right.
Is the remainder of that staying in place?
Yeah. I mean, yeah.
I saw your comment about like a naval provision there.
Yeah.
And something that happens a little bit outside my wheelhouse, so I was just sort of hoping you could.
Sure. Yeah. So, you know, to the question that came in from the live stream, I think I expect that the bulk of it will just sit out, right? And so there's not, you know, the make whole is essentially, hey, if you know we're gonna put this money aside for you, we've got to allocate this for you as an investment, so we can't have you redeeming it right away, or you know we just sort of screwed ourselves. So 4 years was the resolution
of the make whole, like that's the negotiated amount. And so that money will just, when I say it sits out, there's no make whole because we'll just be paying interest over that.
And then on fiber, so as you guys like just internally are trying to think about like and real sort of reflection. And I know you said like we're going to see the drop in line and all that stuff, but as far as like a real reflection, I know it's so hard to think about growing, but I was sort of thinking about like the right way to ask the question. So maybe we're to imagine that all of your 100,000 passings, 37,000 subs were in one market. And so one market, exact same, just everything else the same, like assume same, that's the same. In what way would the consider to? And what would it?
Yeah, it would, look, it's going to be a little more efficient, but not a lot. So, I think we benefit. The fact that we are more of an internet company than the traditional telecom is really what has allowed us to be, to have low enough economies of scale that we're in these number of footprints. I mean, I feel like you were working hard to structure the question to kind of understand inflection point better. So let me just.
Well, it's like how many. Hypothetically, how many subscribers do you need to have? Would you need to have to be able to sell a phone?
Yeah. So it's really what it comes down to is the slower you grow, the more you can sell funds. And so there's not, a magic number for any set of variables. We can solve for that number. Another way to think about that might be, imagine there weren't humans, and there are. So, this is an abstract. And we could just stop building right now, right? We stopped building and we got rid of everybody that's connected with growth. The business starts to become profitable very quickly. Like I would say probably, Dave or George, I don't know if you want to swag that. I think, again, so I'm not thinking about severance costs, nor do I have to, because we're not laying people up. But if they just magically, everybody working on growth came in and resigns tomorrow, you'd see the business be profitable. Yeah.
And so wouldn't you? You obviously wouldn't get to 68% margin, sort of target immediately. That I would assume.
Oh yeah, if we were to do that now, it's that conversation that Jan and I had earlier of, is it 70? Could you push that to 75 if you're in pure maintenance mode? These businesses in maintenance mode are very, very profitable. Right? And the trick is to get there. And again, we've tried to do it, sitting on a stage in front of people instead of, back in the back alley and harder.
Yeah. Just to follow on that one, how well do you think you've been able to convey that to your investor base, just how profitable it would be on a run rate basis? If you stop now, it seems like you've got an investor base that's gone from the domain business, software, high cash flow to high capex.
Yeah, look, it's
cash flow in the long term. That's a very different business. So, how well have you been able to highlight how profitable?
I think here's what I would say. I think I did quite well when we were spending our own money, and the more we started to spend other people's money, the worse I did. Although my performance was identical. So, look, it's. I think it's easy when the numbers are smaller, and we're talking about it in abstract. I get it. There's no question that in many respects I dragged people along for the ride in that respect. I think that different investors, and, you know, anybody here can answer as they like for themselves. You know, I think different investors struggled with that more or less. You know, a couple of you, and you know who you are, were really like, hey, I didn't sign up for this, man. I get it, right? And you know, at the end of the day, what I spent enough time, probably between, for better or worse, between, you know, if we look up there, what's that from? You know, so from, I spent enough time from 2001 to 2012 having to console myself that I was right when everybody said I was wrong. And so, you know, I think that you know, I'm being thought of as wrong more often than I've lived. You know, I've lived more days like that than I haven't. And I know at the end of the day, I'll be judged by the scoreboard. You know, if I'm right, the people who hated my decisions will say, oh, you know, boy, you were right all along. Wasn't that great? And, you know, and all really anybody cares about is if you're right in the end. You know, you always get too much blame when you lose and too much credit when you win. And, you know, you just kind of got to be true to it. You know, I think at the last thing I'll say on this, you heard me say, you know, earlier in the day, I underestimated how hard it would be. I underestimated the pressure it would put on the business. You know, we got at the very hardest time. We had a couple, you know, exogenous variables turned against us. You know, I don't want to say bad breaks because we've gotten good breaks too. Saying earlier, look, we were trying to do this really, really difficult, bring European project financing to North America, and it was going to be a hack. And then the original Metronet ABS got done, you know, and it was like, wow, this is what we've been waiting for. You know, David and I have been talking about something like this for years. So, you know, it's you know, I don't feel front to back unlucky. I think we've got some good breaks and bad breaks, but you know, I did underestimate it. So probably, you know, the short answer, which is too late for, is I did a crappy job of it. Mark?
I just want to build onto that answer.
Yeah.
I mean, this capital markets day was really helpful in terms of updating your assumptions and adding much more granularity in the assumptions around fiber. At the end of the day, it all comes down to assumptions. So investors have to trust those IRR numbers and everything that build into that. While you and the board, they obviously, you see everything from the inside, and you have trust into your numbers and probably some things that you have the validity. You have calculations where you can see, hey, those costs to build, they add up. It makes sense. We don't see that. We have your assumptions, and that's it. And I mean, over the years, it's been really hard to, without further disclosures, and earlier with one of my questions on Alexandria, for example, how much have you spent on Alexandria without any serviceable addresses yet? I mean, there's like 1,000 serviceable addresses, but probably you've spent in the millions. Disclosing such figures would really help building trust into all the assumptions that were presented out there. Yeah. And I think it's like going into the future and into the next couple of months, and maybe in 2 weeks in the Q&A, it will be really helpful and important for the whole equity story and everything to not only talk about your assumptions and updating that, but really trying to share some of the data that you see that adds validity to those assumptions.
I want to go deep on this, so maybe we'll take it out of the room, but let me start a conversation on that. I feel like what we've always tried to do is report actual numbers that validated the assumptions, and that's hard, but that we've tried to. You know, I feel like we've, you know, where it's easy, we've done it. ARPU, you know, as an example.
Yeah.
Where it's a little bit harder, I think we've done a pretty good job. Take rates, right? You know, I think that in this business, you know, churn, nobody doubts us. That's fine. You know, one of the things that happens internally as we're doing this work. Well, if I'm gonna, you know, if I've got to show you what the atomic unit looks like at a profitability level, I've got to include churn. So fine, now let's, you know, we have, and then immediately the company went, okay, now we are reporting churn every quarter, and here's where we'll do it. No. Doing this for Investor Day. We're going to use real numbers, but we're not going to report churn every quarter. And a big part of the challenge there is, again, like you could, you know, what happens over time is that the earnings report becomes a weather report. You know, it's this many degrees and cloudy in Culver City, and it's this many degrees, and, you know, sunny in Alexandria, and it's and so it's that's a balance. When I say it's the stuff, like I feel like particularly with the two tough ones, you know, so I've identified 4, you know, there's the revenue, ARPU, penetration, you know, then there's the build cost and the profitability, you know, churn, that's easier. Build cost profitability, it's harder. I feel like we didn't just wave our arms and say, here are the assumptions. I felt like we dug in today. No, well then, okay. I will call this first Investor Day adjourned. I'll thank you all again. I will let you know that I think it was, from my perspective, at least, very successful and great to see you all. And I love getting you together in one room. And I will probably do it again next year.
Thank you.